All right. Hey, good morning, everybody. Good morning, Cav. Sorry, I was being held hostage by a sneeze, if you've ever had that happen. How's everyone doing today? John Tripp, nice to see you in here. Don Sanchez, good to see you back. Dwight, Ron, Lyle, Cav, Josh, Walter, Andy, Ty, Diamond Dave in the room. Rob, good to see you, bud. Hammond, JW, and JW Roth, nice to see you as well, guys. Welcome to the room. Welcome to education. I hope everybody's doing amazing today. Hope everybody's happy, ready to take over the world, right? That's my plan every day. Good morning. Um, let's talk first about news. And Lyle, I'm about to cover that. About to cover that right now. So let's go through that right now. A lot of you in NinjaTrader 8 got the, hey, it's time to roll. It's time to roll. The 17th, it's the roll date. And crude oil is Gosh, let's talk about everything that's happening today with crude oil. So right now on the February contract, it is trading more volume by about 12,000 contracts over March. Typically, this is the market moves better when the volume is higher. So I'm going to keep my charts on 224. I'm going to stay on February today. Tomorrow, it'll probably get rolled over to March. But I want to talk about something that's happening in crude today, just for everybody. I want you to know it. And we're going to go to news. And every morning I check news. Every morning I make sure that I am not getting in the way of something that may be good. Oh, today is not crude oil inventories. They moved it tomorrow because of the holiday. So that's good. That takes half of the sting out of the crude oil. Wednesday, January 17th, typically this is a crude oil inventories day, which means that not only would the volume be split, but also people would be jockeying for position, waiting for the release. In my opinion, that's the double whammy untradeable crude day. I prefer to just close it down and watch the S&P. But since we're not crude oil inventories, it'll be there. Just understand that half the people that normally push that market in one direction or the other aren't there today. They're split between two. So the volume's a little lighter. The patterns, let them be good, guys. Let them be perfect. Follow your rules today. We'll follow your rules every day. At 8:30 a.m., we did have that core retail sales and the retail sales, and it wasn't a huge deal. It did create a pretty good spike down in the Nasdaq. Ron said it was a dud in the S&P. At 9 a.m., we've got some FOMC members speaking. At 9:15, we've got industrial production. Um, no, Dwight, it is totally different. So crude oil rolls every month. So there's 12 contracts in a year in crude oil. The S&P is quarterly. So we're okay for a little bit there. There you go, Rob. Guys, at 9:15 we have a medium impact industrial production. Medium impact means that it could affect the market. It could create a bounce or a bump or a jump or a spike or something that messes with you. So when you understand when the news is happening, we're not worried about what they're saying, guys. Nobody could care less about what the news is saying, except the people that move the market. They may have a reaction to it. We just want to know where it is so we can stay out of the way of their reaction. So that's part of my routine every day. If you're brand new with me here. I always go to forexfactory.com calendar. You can go to any news source you want, but I'm looking for these high impact, I'm looking for these medium impact, and I'm really just kind of telling myself it's okay to stay out of the way of the market when it happens. Everything that I talk about every day, all the rules that I discuss, all the looks that are shown, the ideas that are presented, everything comes from the Next Gen Education page. So I know that I have some new demos in here, and welcome to the class. It's great to have you. Um, there are no secrets with Nexgen, guys. I give you everything you need to be successful, everything you need to take trades that are typically winners more than they're losers. I present you a very simple plan that allows you to find success while you continue to grow with the software. And this class is dedicated to simplicity. It really is. The first hour, we're going to talk about rules, guys, and we're going to talk about the high probability trend trade. That's our first. This should be your first Because the high probability trend trade is a trade where each indicator on every chart is going to agree with the trade, guys. This is the best of the best. This is the easiest of the easy. This is a trade that is chock full of advantages. Um, and we discuss it in great details. And for the new user, if you focus on being able to enter with this high probability trend trade, it gives you the amazing ability to read your charts. And reading your charts is about 90% of your day. If you've spent any time in the markets, you understand that advantages aren't present nonstop. They're just not. We have to be a little bit patient sometimes. So 90% of your day is going to be spent being a chart reader, waiting for advantages, looking for these things to come together. 10% of your day will be hopping on those advantages and entering a trade, and doing all those things that you wish you could do 24 hours a day. But chart reading through the high probability trend trade, learning how to read the charts is going to give you the ability to do three or to understand three key concepts. You will understand where the market is likely to continue. You'll be able to use this continuation point for an entry for the high probability trend trade, and that's exactly what it's designed for. You'll also understand where the market is likely to go. As you grow with the software, as you become more familiar with it, you're going to begin to recognize where it's most likely to go based on momentum, based on Fibonacci. And this is going to allow you to orchestrate a management plan that makes sense, that keeps you relying on pragmatic decisions rather than hoping or wishing or wanting. Um, and then finally, you'll understand where the market is likely to stop, guys. And this is what we call termination conditions. And a likely to stop area is really just where decisions are being made. It's where the people that move the market are making decisions, where they are buying, where they're selling, where they're taking profits. You're going to be able to identify these areas, and you're going to have a simple recipe for understanding if they are likely to stop the market, if they have the potential to break. And you'll also see them reverse the market very often. When one of these likely to stop, one of these termination conditions reverses the market, it creates what we call a strong top or bottom. And a strong top or bottom sets you up for the highest probability winning trend trade that you can take. And this is a trade that typically wins 70 to 80% of the time. And this will be our focus for the first hour. This is a trade that creates confidence through the memory of success. And then my favorite part is this is a trade that only has three rules. It's three simple rules. We're going to discuss them visually. We're going to talk about them verbally. Um, but three rules. Each rule is designed to provide you an advantage. And I want you from day one to start speaking to yourself in terms of advantages. Every time you open up a chart, I want you to say, I have the advantage of, or this is my advantage, this is where the advantage isn't present. And what you'll do is you'll begin embracing and trusting these advantages and realizing how they come together to create a trade. Because a trade is momentum, it's a clear path in an entry area. Momentum is provided by strong triggers. A clear path means that you haven't reached any of those likely to stop areas. And the entry is going to be based on some simple rules that allow you to capitalize on small pushbacks in the market. These three rules that provide you the recipe for a high probability trend trade, that trade that typically wins 70 to 80% of the time, these three rules happen on only two charts. For the new user, simplicity is key, giving yourself less to think about, being able to focus on the best of the best. And we use two charts for a reason. There's a large chart and a small chart. And the easiest way to sum it up is the large chart represents what the crowd that moves the market, the large crowd wants to have happen, the people with the money, the people that push, that create trends, that react to these areas. The large chart is very much a representation of what they want to have happen. The small crowd is a representation of the small crowd, right? The small chart is the small crowd. And the small crowd is notorious for fighting the large crowd. They love to put their dukes up and take a swing every now and then. And they create these little fluctuations that you'll never see in the large chart, but on a smaller, faster chart, they can be identified and you're going to capitalize on them because these are what push you to the point where the market is most likely to continue. So you're going to be able to let the large chart define the direction, which direction you should be trading. And you're going to allow the large chart to define the momentum. And that's rule number one. When it's met, you will have the advantage of momentum, a market that is likely to continue in the direction of the trend. And you'll also define those areas, those key areas that may create problems or that may establish a very distinct advantage if they reverse the market. All of this comes from the most current bar on the large chart. So you'll look at the first bar and you'll understand the direction, whether or not there's momentum, and if you've reached an area. If your rules are true on the large chart, if the large crowd is giving you everything that you need to look for an entry, then you turn your attention to the small chart. And the small chart's a refinement. It refines that broad stroke of a brush. It takes that one bar on the large chart, that most current bar, but it'll literally break it down into 15 to 30 bars. You're going to see the movement within the broad stroke. And that's what gets us into the market. Rule number three gives you a very clear and concise set of rules that allow you to take advantage of the direction, of the momentum, of the areas, and seek an entry where the market is most likely to continue. And this refinement process is going to allow you to reduce your risk and to manage and to really maximize your profit potential. So, three rules on two charts, guys. Keep it simple. And this is how the day goes for you guys that are brand new. We spend the first hour learning the Fibonacci rules and the trigger lines for when it's okay to trade. We're going to talk about the rules for the high probability trend trades. I'm going to show a lot of pictures. And in a perfect world, you guys ask a lot of questions. You guys feel free to simulate while I'm doing this first hour. Take trades that you think you should be in, right? Take trades that you think fit the rules. Take trades that you're sure fit the rules. But the idea is that you post your pictures in class until you're sure that you have the correct rules. Because one of the common threads with new traders is they love to get lucky. They love to take trades without advantages. And just because the P&L goes up, they're feeling like rock star. And it creates this false sense of security. My goal for you guys is that you're trading with a statistical advantage each and every time, that you're trading a pattern that has been proven. John Tripp, I'll tell you what, we'll talk about the mechanics when we go through the entry process. Sound good? Awesome. Thank you for putting that. Don't let me forget. Sometimes I see shiny things and I get distracted. Guys, these short-term victories, these breaking the rules and getting lucky victories, translate into long-term failure. They really do, because the high probability trend trade is a methodology that repeats itself every day. You're going to see it on crude oil, on the S&P. You'll see a version of it on the Nasdaq. I have people that trade stocks with it, people that trade options. We've even had farmers that hedge their soybean crops using the software, using the patterns. So. The idea is that we want you taking the correct trades, getting into the market with all those advantages, and then we're going to simplify heavily. This is a big part of what I do, is giving you as little to think about as possible that still gives you the opportunity to be successful while you become a chart reader. We're going to talk about that high probability trend trade extensively. That's the first hour. And then we're going to talk about and introduce you to what we call a medium probability trend trade, which is the trade where most of your indicators line up. However, an issue exists. And when I say that an issue exists, I mean that one of those three advantages is not present, which means that you've got to change gears in your brain a little bit. You've got to manage a bit more assertively. Your ability to read charts is going to identify the problem. It's going to allow you to manage assertively. It's going to let you identify trouble spots and take quick profits and get to zero loss levels. And the first one that we talk about will be void of a clear path. But you need to understand what looks you're going to commit to. You need to commit these looks to memory. You need to be able to recognize them when the market isn't moving so that as the market does move, it's not overwhelming. It almost seems like it slows it down. And that leads us to the left side here. Your step-by-step path to becoming a confident trader ASAP. And I know that this path works because I fought it tooth and nail when I started with the software. And I was relieved of about 5 grand in a day because I had no idea what I was doing. Step-by-step path to becoming a confident trader ASAP. Post your pictures in class, guys. I can't stress this enough. Post the good, post the bad, post the wins, post the losses. And even if you have a question, take a picture and drop it in the room. Say, hey, Mark, I'm looking at this. What the hell does it mean? And every time you post in the room, It's like getting a private session with me. It really is. Because I'm going to look at your chart and we're going to talk about advantages and we're going to see what you did and we're going to talk through it together to make sure you understand all the different things that went on. In order for me to do that and for me to really do that well, for me to be the best at my job that I can be, I need you guys to give me information when you post in the room. I need you to tell me why you did what you did. Even if it's not a high probability trend trade, you telling me why you did what you did allows me to make sure that you're reading your charts correctly, to make sure that you are recognizing advantages and disadvantages. There are no wrong answers. I can't stress that enough. Mistakes are where we grow. And if you've ever spent any time maybe in the gym, right? Lifting to failure, because when you get to failure, the body adapts. Guys, every time you lose a trade, it's an opportunity to grow. Don't be afraid to share those. Show me where you enter. It's important that you show me both charts, that you show me the broad stroke of the brush and you show me the refinement side. So when you show me where you entered, we're going to make sure that it was the entry with the least amount of risk or maybe the most profit potential. Um, Sometimes we'll just celebrate how great you are at this, and sometimes we'll find a better opportunity. But we're going to do that together. And then show me where you get out, because management's really the second piece of the puzzle. We're going to talk about entries a lot for the first hour, but once you're in that trade, you got to do something with it, right? So we'll talk about management as well. This all happens in the first hour, guys. The second hour, you'll notice if you're brand new, people are posting pictures in the room. The second hour after we discuss the rules is where we start looking at your charts. We start discussing it, making sure that they're annotated, making sure that you're giving me the best information for the best feedback, um, because it is an educational class, right? So no matter what kind of trade you're taking, we're going to talk about advantages and disadvantages. The second thing is using your spreadsheet. Nexgen provided you guys a spreadsheet, and there's three tabs on it. I'm going to drop a copy of mine in the room right now, um, just in case you can't find it. There it is. The first page is your trade journal, guys. And the first page, that trade journal, every time you take a trade, drop it in there. It's going to ask you, how did you feel? It's going to talk about what were the advantages, what was the result. And what it is you're going to go back and study this every morning. You're going to pour a cup of coffee, maybe some hot tea, I don't know, Nestle Quick, and you're going to ask yourself, what I did yesterday, what worked, what didn't work, what felt easy, what felt forced. And every morning you're going to give yourself this couple minutes of study so that it's going to prepare you for the day. If I did this well yesterday, I want to continue to do it well today. If I took this trade yesterday in determination conditions, I want to try to avoid those today. And it sets your mind right, and it will accelerate the learning. The spreadsheet does three things for you. It gives you a trade journal on the first page. On the second tab, this is where you're going to build your plan. So you're going to take all of these looks. Every time your rules are met, every time the advantages are in place, when you see a trade that is everything you could ever hope for in a trade, take a picture of it, annotate it, talk about why, but drop it into your personal trade setup looks. This is you literally creating a trading plan for yourself. And then finally, there's the client trades. This is where I have stolen greatness from you guys. When you post in the room and it's just really grasping these advantages and you're taking these trades with momentum and with a clear path and you're entering at the best spots, a lot of times I steal it and I put it into the spreadsheet because repetition creates recognition. And if you're brand new and you scroll through even 50 of these 300 pictures that are here, you're going to begin to see this common thread. You're going to begin to see this odds favorable momentum, and you're going to start to notice what it looks like when the path is clear. And you're going to notice common threads with the entry, how they're waiting for a pullback to the best area rather than just jumping in. And when you really spend time and you study pictures, the looks become easy, and that's the goal, guys, is that these looks become easy, second nature, that you can open up your chart and do the analysis in a matter of seconds and make the decision on whether or not you should be taking a trade. So we're going to focus on the high probability trend trade. I'm going to get going here. I can't see your faces if you have a question, so do me a favor. If you have a question, raise your hand. Tell me, go, hey, Mark, back it up for a second. Let's talk about these strong trigger lines, rule number one. And I'll say, absolutely, let's take a look. But strong trigger lines on the large chart, right? Large chart leads the way. Most current bar. The only way to have strong trigger lines is to be trading with the direction of the market. And if the background is green on your large chart, The market's going up. Just look for rules to be met for high probability trend trades long. If it's red, it's going down. Look for your rules to be met for high probability trend trade short. This simple endeavor by you will eliminate a lot of the common mistakes that new users make. For whatever reason, we're all alpha males and females. We want to fight the large crowd. Your raise hand is disabled. John, all you have to do is type in the room. Just anytime you have a question, hey, Mark, right? Um, and just feel free to type it on out. If I miss it for some reason, sometimes I scroll. So as we get into the chart review, what you'll see is that I'm trying to show it to you here, is I have to scroll up to go find the presented charts. If I ever miss a question, a comment, a picture, all you guys have to do is go, hey, Mark, I think you missed me at 9:45. Will you grab that, please? To which I will reply, absolutely. Let's go take care of that. If you have to leave early, if you have to go to work, I want you to say, hey, Mark, I have to go to work in 20 minutes. I'm not a professional day trader yet. Can we review my charts before I step out? And I'll always say yes, guys, and we'll get in, we'll do that. But traditionally, first hour, we're going to rock it out on rules, guys. Red is down, green is up. Go with the trend. Life gets easier, and you'll see it right now. If I go to the live market, this is crude oil, guys. Is it going up or down? And this is a great little opportunity for you newer guys to feel comfortable posting in the room. The background is green, therefore the market is going down, sideways, left, right. It's up, absolutely, John. You are already a pro at picking direction, and it's on every market, right? There's the Nasdaq going up, and there's the S&P going down. That background color sets you up right off the get-go, and it just says, hey, let's look for rules to be met for that high probability trend trade short. Once you've established the direction, they are Mario, unless I make a mistake. But so far today, I haven't made one. So um, if you want to go back and find the lessons from the YouTube page, go to live. I'll give you guys the link right now. Guys, there's about 150 videos in there, and the first hour of every video is rules. But if you ever are in class and you're like, man, that was the one, that was that profound moment, that lesson that I really needed, go back and save that video, watch it a few times, make sure that you get those lessons that you need. Once you've established the direction, let's go ahead and look for strong triggers. So strong triggers means on the most current bar, guys, that the small triggers, these solid lines, and the large triggers, these dashed lines, they have separated. They're both wide, strong in the direction. The only way to have strong triggers is if all the colors match. Small triggers are green, they're wide, they're not pinched off like this, and they're in the direction. Large triggers are doing the same thing. And when the small triggers break away from the large triggers, let's use the scissors analogy. When the large and the small separate, when the small break away and the large are wide and angled up, do you notice how it looks like scissors? And when scissors open, when that space happens, when that gap is created between the two, guys, that's your strong trigger look. This is when the odds are favorable for the market to continue in the direction of the trend. Odds favorable momentum is the battle cry in this room. Odds favorable momentum is that first advantage that you give yourself. When you have odds favorable momentum, this is the most favorable look for buying Fibonacci support on that smaller, faster chart, or for selling Fibonacci resistance on that smaller, faster chart. On the large chart, with just that one bar, you're going to see these tails or these wicks form after the fact. This is historical. This tail or wick is literally a retracement, a little pushback on that small chart. You will be able to pinpoint where that tail is most likely to happen. You will be able to go back and circle these tails and study this look and take pictures and begin to build your trading plan. But odds favorable momentum, guys, this pushes the market in the direction. This is like a loaded semi, and it is flying down the highway. Odds favorable momentum can also break areas, those key Fibonacci areas. When the market comes into them with this much force, it can break the area. And I'll give you the recipe for that. But odds favorable momentum will also allow you to be a little creative with your rules. It'll cover mistakes. Odds favorable momentum can push you in the direction even when things aren't perfect. So if I'm never giving up an advantage, I'm never giving up momentum. This really leads the way, guys. This is the best of the best. And odds favorable momentum doesn't happen all the time. Sometimes those small triggers work their way back inside of the large triggers. Those scissors close, if you will. When the scissors close, we've lost the momentum. We've weakened the large triggers. And weak large triggers mean that anything can happen up or down. So it becomes a little bit of a roll of the dice. Very often you'll see weak triggers at key areas when the market is reversing. Sometimes weak triggers, even in the middle of nowhere, will create a deeper push and kind of ruin your chances for success going to the upside. But weak triggers, it removes that advantage, guys. And I'm going to show you and I'm going to drop it in the room as well. I'm going to show you the rule number one, guys. 90% of what we do during the day is waiting for advantages. You're going to hear me say that a lot because patience is such a key part of what we do. And you'll notice starting on the left, the market's pushing down. There's separation between the two. Those weakened triggers come to be. Anything can happen. You'll see it annotated ACH on my charts. Anything can happen, and there's a reversal without the benefit of Fibonacci. From the reversal, it creates odds favorable momentum. You'll notice that there's one of those tails. Remember, this isn't after the fact historical. We're not waiting for tails to form, guys. You are pinpointing where the bottom of that tail is most likely to happen. That becomes your entry, the most likely to continue spot. A lot of you got long, took it up, made some money, and then we weaken those triggers again and another reversal. From the reversal, odds favorable. There's a tail, pushes down, probably a big fib right there. And then we get into this transition phase. We get into this point where the colors don't agree, where the large trigger and the small trigger don't agree, where the triggers in the background don't agree. Guys, this is your transition phase. This is where the people that control the market, and just a heads up, it's not you that controls the market. This is where the people in control are fighting, where the buyers and sellers are jockeying for position. They're duking it out for supremacy. You recognize that fight through the trigger lines not matching each other or the background. This is a huge red flag. This is you having the opportunity to tell yourself the advantage of momentum isn't present. I don't know if the market's going to push in the direction of the trend. I'm going to sit on my hands and I'm going to let the fight happen. And you're going to see this fight at key areas. You're going to see it in between key areas. And next gen users have this amazing advantage of not getting caught up in that consolidation, not getting caught up in that fight. We sit on the sidelines, pop a little corn, high five our buddies, and wait for somebody to create odds favorable momentum again, waiting for the buyers or the sellers to take control. And then we start the process again of looking for our advantages. So let's go back to the live market again, and I'm going to blow up the S&P chart. I'm just going to make it huge. And I'm actually going to take everything off of it but the trigger lines because I want you to begin trusting in the trigger lines. And it's pretty incredible. Odds favorable momentum, the market continues to push down. There's a tail. Probably an opportunity for a short trade. Since I have odds favorable and all that, let's circle it. And we'll see what it looks like on the smaller, faster. And then my triggers begin to weaken. You can see them coming in. They're inside. And the market continues down a little bit. And there may have been a medium probability. But those weak triggers, sure enough, there's a push, right? And then my colors don't match. And there appears to be a fight. And then I get a reversal. And the odds favorable momentum. And there's a tail. And it continues all the way up until the trigger lines begin to weaken. There's your reversal. Odds favorable. There's a tail. Dollars to donuts, there's a mid band or something right there. But with all that momentum, it bounces but continues down. There's my weakened triggers. Does everyone see how big that bar is? A second up bar. Weak triggers, deeper pushes. And the cool thing is guys, you can scroll back and you can just keep looking at this. And you'll see it over and over. Odds favorable, there's those tails, they weaken and it reverses. Odds favorable, there's the fight and down it goes. Odds favorable, it weakens and there's your push up. So this is how you're going to begin developing trust. There's another odds favorable in a tail, guys. It happens all day long. It happens every day, but not every second of every day. Sometimes you have to be a little patient. And it's pretty cool because once you learn to trust momentum, rule number one's done, and it only takes a couple minutes to learn it. The separation means the advantage. When they're together, it means that it's gone. And then once you have the advantage of momentum, you're going to look for a clear path. You're going to look for key areas on the large chart. Remember, the large chart defines areas, areas that can stop the market, areas where decisions are made. These areas can be divergence high lines. It's a magenta line that prints off of a pivot. And what this tells you is that there was a loss of momentum at that particular pivot. It's not a termination condition, but divergence is a line in the sand, a visual representation of a loss of momentum. And then from a low, you'll see it as cyan. And I'm going to show you how to use these. We're going to look for red Fibonacci resistance, blue Fibonacci support, or these yellow one-to-ones, guys. And these are the areas that may stop the market. These are the areas that may create a reversal. These are the areas where decisions are being made by the people in charge. On the large chart, you don't always see the fight. On the large chart, it may look like a slower moving chart, but I'm going to show you a picture that I took this morning for you guys. And this was on the NASDAQ. Price reached one of those key areas, and you don't see it on the large chart so much, but you can see it on that smaller, faster chart. You can see the fluctuation. You can literally see the fights happening. Um, and these areas are where buyers are trying to buy and sellers are trying to sell, and profits are being taken and positions are being entered. And you see it on the small chart fluctuations. The idea is developing enough trust in these areas and being able to read whether they're likely to hold or break so that you can have the advantage of not getting caught up in that decision-making process. And there's a very simple recipe for identifying termination conditions. It starts with price reaches the area, and that's always the first thing, guys, is dynamic Renko bars have to reach the area. Here's termination conditions at a high. Dynamic Renko bars, the representation of price come up and they reach that divergence high. When they reach the divergence high, the only thing that you have to do is ask yourself, where are my trigger lines? If they remain below that line is a termination condition. It may stop the market. It may create an untradeable bounce. Decisions are being made that you don't want to be in the way of. If it reaches Fibonacci resistance and the trigger lines remain below, this is a termination condition. This is an area that robs you of your clear path. And then the same thing on those yellow one-to-ones in resistance. These are all termination conditions at a high. And if you can have them at highs, guys, we make money both ways. You can also have them at lows. So the recipe always remains the same. Price, your price bars reach that key area. Here it's one-to-ones. Notice that when it reaches it, all of the trigger lines remain above. There's no reason to try the short. There's no reason to hope here. Just sit there. I don't know, C-Dub, show me a picture. My imagination's not that good. Price reaches support, and all the trigger lines remain above. I'm not going short, even with odds favorable momentum. And then price reaches that divergence low. Here it's just a pivot with a loss of momentum. Here it's actually a termination condition. So this is the recipe, and it really is. It's a pretty simple recipe. If price reaches an area and the trigger lines remain above or below, depending on which direction you're going, it's an area that may stop the market, that may create a reversal. It's an area that can create problems for you, and it should be a big red flag telling you, sit on your hands for a second. Let's see what happens. Let's see what the decision is. So if I go to the tops and bottoms section, again, we're going to look at some examples. Price reaches Fibonacci support. Absolutely none of the triggers are capable of breaking. This is an area that may stop the market, that may create a reversal, or that in this particular case simply creates an untradeable bounce. We knew that that was the case because price reached and the triggers remain above. So this is when the path is not clear. This is when the termination condition is present. When is the path clear? In this case, price came to Fibonacci support, and we just sat on our hands and we said, let's see what happens. There's a lot of momentum. It has the potential to break, but I'm just going to let it break. Small triggers break through the area. Large triggers break through the area, guys. Once both small and large get past the area in question, then you have what's called a clear path. The area is broken. Um, and you'll notice that um, with the clear path, there's odds favorable momentum. With the odds favorable momentum, there's one of those tails. You guys pinpointed where to get in and carried that momentum to the next area. So, John Tripp, absolutely there is. And we're going to go through the entry rules, but let me show you a picture just so that I can give you something to chew on until we get to the entry rules. And I promise the entry rules will clear it up. But this one's got a box on it. There's your one bar on the large chart. And do you notice that it has odds favorable momentum? Do you notice that we haven't reached that next area? So the bottom of this bar on the large chart is the beginning of a pullback on the small chart. The top, that tail or that wick, is actually an area of resistance inside of favorable large triggers. So that one bar on the large chart, and when it happens right in the moment, when you make the decision that it's time to take a trade, your decision-making process starts with the market all the way down here. Your actual entry comes from what ultimately should be the top of this bar, the top of that tail, that wick, that little retracement. And you see it here as well without the circle. But that black box around the one bar is all of these bars inside. Does that make sense, John? Awesome. But first, we got to make sure we're not trading into areas. First, we have to make sure that price hasn't reached the area, that we do, in fact, have a clear path. And that clear path, once again, whew, I've got a lot of pictures open, don't I? Let me close some of those, just so I don't confuse anybody here. Whether or not the path is clear, 4 charts for the NASDAQ, Dave? That's one chart more than I use. I look at the 34 on the NASDAQ and I use the 13.2 for my entries. That's how it is in the workspaces as well. It's a 34 for your large chart and a 13.2 for entries. So let's go back and talk about whether or not areas are broken or not broken, guys. No triggers through the area. Price reaches, no triggers, no trade. You're sitting on your hands and the path isn't clear. In the moment, you have no idea what's going to happen here because you're not in control of the market. Um, there's 3 possible scenarios, guys. It's either going to break, which means that the small and the large clear the area of resistance. It begins to act as support. The path is now clear. Now we're looking for the rules to be met for the high probability trend trade again. It may reverse the market. And if that termination condition reverses the market, it's a strong top. If that termination condition reverses the market from a low, it's a strong bottom. And that's the precursor for the highest probability trend trade you can take. Or you're going to be able to recognize the potential of the area to break. And this potential to break relies on a couple things. The first thing is it relies on odds favorable momentum. The small triggers outside of the large triggers, that best of the best. The scissors are open. You've got the best look of momentum you could ever hope for. And remember that I said strong triggers break areas or have the potential to break areas. When the small triggers smash through the area, the large triggers remain below. 50% of your trigger lines have made it through. 50% of your trigger lines have not. Guess what we call this trade? The 50-50 trade. This is your first medium probability scenario. Because the area has the potential to break with all that momentum, but hasn't broken yet, it's not a clear path. And if it's not a clear path, rule number 2 isn't met. And if rule number 2 isn't met, we're no longer in the high probability realm but I'm going to give you a recipe for taking this medium probability look um, and optimize your chances of success when you take it. But if you're forfeiting the clear path, it's imperative that you don't give up the momentum. It's imperative that you don't give up the perfect entry area. And then C-Dub helping us on that 50-50 here. When the small triggers smash through a potential problem area, the large triggers have not, there's C-Dub recognizing this is what we call a 50-50 trade. And a 50-50 trade is really the potential to break, but it hasn't broken yet. The path isn't clear. Thank you for the picture, C-Dub. That was perfect timing, and that's an awesome read. That's exactly what we're looking at there, the 50-50. Someone's been studying. I love it. So let's go back to the user guide. And we're just going to go through a couple termination conditions. Guys, it's going to take you, I don't know, maybe 3-4 days to really get comfortable with the idea. Um, Price reaches the area. If the triggers remain above, it's okay to do nothing. It's all right to not hope that it breaks. Here we see price come down and go up. It creates a pivot. At the time of the pivot, there's a loss of momentum. I know this because that cyan line prints. Price did not reach this cyan line. Price created this cyan line because this line doesn't print until about the third bar up. It's when price comes back and um, and reaches that area, the triggers remain above. Now it's a termination. So let's go to crude oil. So right now, John, what we have is odds favorable, and there was an opportunity to take this trade here. And then we reach Fibonacci resistance and the triggers don't break. That's a termination condition. No matter what happens next, it's a termination. And here the small triggers haven't quite made it. And we're going to talk about this small chart look with 3 divergences. And I'm going to show you how it gives you the advantage of recognizing potential change. But until the big triggers get through, absolutely, the area is not broken yet. And I think one of the easiest ways to begin to learn trust on termination conditions, triggers don't break support, and it pushes right to the one-to-ones where the triggers don't break, and it pushes us back and up and back and up and back and up and back. And what you see is these times of consolidation. And John, if you have any experience in the market, you know that this is one of the most dangerous spots for most traders because we start predicting, we start hoping, we start wishing and wanting that it would go in the direction of our trade. But Nexgen allows you to see these key areas and that you don't, in fact, have a clear path just yet. Does that make sense? I say, does that make sense a lot? It's important to me that you understand. And it takes a little time. Don't be afraid to scroll back and see how many times price reaches these yellow one-to-ones. The triggers don't break, and look at the bounce it creates. It doesn't end the trend, but it keeps you from taking that next short trade. Even in the middle of the night, they react to Fibonacci support. Good morning, Adriana. All the triggers above support when it pulls back and the market continues back up. There's that divergence high line. See how it takes it out by 1 tick? Next-gen users knew, don't go long into that. And sure enough, that's what starts the reversal. Good morning, Miss Cindy. So it takes a little bit of time, John. It's going to take you a little bit of study to get through there, but the recipe will never change. If price reaches, do you see how, I'm trying to blow it up. There we go. See how the small triggers don't really make it? They're kind of just resting on the fib. Large triggers are still below. Look at the reaction on your smaller chart. The top of price, just to give you that refinement again, that was the top of the bar right there. If the market decides to go up, notice that this is still in the bar and it's all the way down here. All of this is the insides of that large bar. So when the rules are met, and let me scroll back a little bit, if you circle these tails, that refinement process brings it directly back, and that's where the market continued up. And this is what we're working towards right now, John, is understanding that with this much momentum and the potential to break an area, there's an opportunity for you to enter the market on a little pushback and take it all the way up to that key Fibonacci area. And then once you get there, you can take profits and let them fight it out again. It's nice when the market gives us that example, but that's exactly what we're in the midst of teaching, is how to capitalize on that. But first, I want everyone to be comfortable with termination conditions. When the market turns from a divergence low, it creates what's called a pivot stop out, and you'll typically see price take out that divergence low by a few ticks, a point. The triggers never break it, and it reverses it, guys. Pivot stop outs are powerful, and they can reverse the market. They're even more powerful when they coincide with Fibonacci, those key Fibonacci areas. Um, and this picture is your first reminder of how 90% of your day can be spent waiting for these advantages to come into place. And it gets frustrating for the new user that wants to be active. So I'm warning you right now that the most advantageous thing you can do when there's nothing to do is nothing. Price accelerates. Smalls are starting to break above the large. Everything says up, but it reaches Fibonacci resistance. When it reaches Fibonacci resistance, John, you ask yourself, where are my triggers? Well, they've all remained below the area, which means that it may create a bounce, it may create a reversal, or there may just be a big, ugly fight there that you don't want to be in. Um, and sure enough, you don't go long because the rules aren't met, you don't have a clear path, and you get this huge push right off of that key Fibonacci area. You also get a loss of momentum, but this loss of momentum doesn't happen until about halfway between the two fibs. So you don't know that it's happened. You just went through rule number two rules. Price reaches Fibonacci support, and when it gets there, all your triggers remain way above that area. There's a huge gap back to the large triggers. This is actually something that we call the gap theory. If you reach an area and there's room for a full bar to get back to those triggers, it's likely to close the gap. And sure enough, it does. You're still sitting on your hands. You didn't go long into resistance. You're not going long into support. And then from support, that fight continues and the buyers push. And you reach resistance. And when you get there, all the triggers remain below. And you reach the divergence high and it creates that pivot stop out and all the triggers remain below. And that second level of resistance and all the triggers remain below. We've got actually three terminations in the exact same spot. That adds a little strength to it. It's also one of those pivot stop outs. And I want you to see what happens. There's separation between the small and the large coming off of that area. I'm getting that odds favorable momentum. The bottom of the bar has not reached Fibonacci support, which means that my path is clear. So with odds favorable momentum and a clear path, there's your 10%. There's that little pullback on the smaller, faster chart. That's where you're going to pinpoint exactly where the market is likely to continue. This entry becomes the highest probability trend trade that you can take. That 50 or that 70 to 80% winner. That confidence through the memory of success. That one that offers the best chance of victory. And even as a new user, you're going to have the simple recipe to be successful while you become a better chart reader. And then let's do one more. Because the market's nothing more than a fight between buyers and sellers, right? That's all it is. Buyers push, sellers push. The easy money for the average user is in between key areas, when key areas have held, right? Because even with odds favorable momentum, the market runs into these one-to-ones. Notice that the momentum smashed support, and then those yellow one-to-ones act as a little bit of a goalie. And when they reach, none of the triggers break, guys. And the more you look at this historically, the easier it is to recognize in the moment. Absolutely no long trade or short trades because we've reached an area that may stop the market. And then the buyers push and the sellers push back and the buyers are fighting. And do you notice how all the triggers remain below Fibonacci resistance and all the triggers remain above Fibonacci support? And your trigger lines don't match. The background are each other. Guys, this is that fight that so many traders get caught in the middle of, that so many traders give so much money away. And I have watched accounts blown out in 30 minutes in the 90% where you guys are exercising your patience. Well, eventually you get the green background, you get the green triggers, you get the odds favorable momentum, and everything's above resistance that's now acting as support. And there is your best of the best entry. There's that tail. There's that 10% that takes you off to the next key Fibonacci area. Cream, Dwight, what are you asking me? What if it's odds favorable momentum and no termination conditions on the 13-2? Doesn't that mean that your first two rules are met? And almost areas inside a favorable large trigger. So you're asking me to imagine what it is you're talking about. Show me your 5-1 and we'll talk about it. I'm going to talk about entries right now in just a second. Um, but there's two sides to every trigger. There's the business side for the long trade, and then there's the wrong side. So it depends on which side those areas are on. We'll cover it more, and I'll show you a couple examples of it. But guys, if you want me to visualize something, it's easier to show me the picture because I have an artsy fartsy brain. And I will draw dragons and wizards and all sorts of stuff going with your triggers. Um, guys, take this picture. That's a great reminder of patience. And then sometimes the market turns from nowhere, guys. And what you'll find is these key areas are huge. They're amazing to creating advantages. But the market does what the market does. And sometimes you'll have a clear path. And sometimes everything says down and the market goes up. And sometimes you've got odds favorable momentum and a clear path. And then the market goes down. Dwight, what are you showing me? Is that on the good side or the bad side? What do you think? Is that on the winning side or the potentially losing side? You have to make these decisions. But without momentum, even with a clear path, you got to make that decision. For me, three divergences, and this is what we're going to talk about right now, three divergences in the same price range may terminate a trend, right? So that's what I see. It might win, but is the advantage there? And guys, this is such a key concept. And Dwight, thank you for saying this. Guys, you might take the crappiest no advantage trade in the world. You might fight triggers and direction. You might fight the entry rules. You may trade directly into areas. You might break every rule that I've ever taught in my life and make $1,000, right? And then you have to ask yourself, did I get lucky? Is this something that repeats itself over and over? Right? Is this something that I want to risk my money on? Is this so many advantages gone? Is that something that I have to take anytime it presents itself? Or do you say, is this repeatable? Is this something that happens over and over? Is this something that when I see this pattern, it wins more than it loses? And that goes back to the whole I want you practicing at least having advantages getting into the market. I watch so many people get lucky and then lose money because the luck runs out when you go live. So let's focus on the advantages. Guys, you can take whatever trades you want. You can get in wherever you want. You can have whatever looks you want. That's okay. But here for the educational room, my job is to teach you to read indicators and to give my new users the best chance of success. I'll never tell you that your trades are wrong, but we'll identify advantages and disadvantages, and then you have to determine whether or not you want that to be part of your plan. Large chart defines areas, guys, and we said it in the beginning and we pointed it out. Large chart defines the areas. Large chart, we use these lines on the large chart to determine when we've gotten to a problem. And Dwight, there's more going on your chart than just an area outside of the triggers. When we go through the analysis, we'll talk about it because there's more to say about it for sure. We're going to use the lines on the large chart to determine whether or not we've reached a termination condition. But we can use the idea of divergence, the loss of momentum, on the smaller, faster chart to give us the same idea if the trend may be ending, guys. And three divergences in the same location may terminate the trend. All caps, bold, underlined. It may terminate the trend. It doesn't mean that it's guaranteed to, but when I see three divergences in the same location, it eliminates my statistical advantage. It eliminates my clear path, whether it goes down or not. Three divergences may terminate the trend, whether it's from a lower or from a high. It becomes more powerful When the small triggers work their way inside of the large triggers, you find yourself in that anything can happen triggers look. And it's more powerful still when the third divergence is higher than the low or lower than the high. It creates a head and shoulders, which just adds fuel to the fire. You're going to see this look, these three divergences at a low, these three divergences at a high, and what it's going to do is it's going to use that smaller, faster chart to show you the change that you can't see happening on the large chart just yet, because the large chart's a slow moving chart. It's a broad stroke of a brush. So you may get those three divergences in just 2 bars where everything looks like it's still going up. Um, you'll see it from a low, from a high. You can also use it as a management tool. If you're in the perfect short and three divergences print, it becomes an opportunity to manage. Same thing with a long, um, and it'll help you identify these lows and highs that aren't really coming from a key area. And CW, that looks like it is waiting on CL. No triggers through the one-to-ones, directly into resistance, and look at all of the divergences happening right at that key area. 1, 2, 3, 4, 5 of them, right? That market may still go up, but I'm recognizing, thank you for the picture, CDev. I'm recognizing that I'm at a termination condition. I'm recognizing that I'm at a termination condition with multiple divergences. My advantage of a clear path is out the window, right? So I'm at least going to let the small triggers break with some momentum to make a decision on whether or not I want to continue going long. C-Dub, outstanding picture and very timely. So guys, give me a Y in the room if you're with me. If price reaches the area and the triggers don't break it, it's okay to sit on your hands and do nothing. If both the small and the large get to the other side of the area, well, then the area is broken. Termination conditions, once again, they happen all day as well. Terminations may stop the market cold, but when support behaves as resistance, it may create an opportunity with that momentum in the clear path. There's another one of those tails. And notice that support breaks, small and large get below everything, and it pulls right back where support's behaving as resistance. But three divergences may have kept you out of that trade, right? That might not be your money. And this is the NASDAQ, guys, and NASDAQ examples are a little bit different. Large chart rules are the same, entry rules are certainly a little different. This is the S&P. Hits support, pulls back to resistance, right? Triggers don't blink, continues down, hits support, pulls back to resistance. Support becomes resistance, and look how it happens there. Pretty awesome. Over and over, guys. Scroll through, look at your charts. You're going to understand um, just how powerful these key fibs are. And then once you have no termination conditions, sorry, I'm trying to get to my rules. Once you have strong triggers, right? Once the large chart has told you that you have the advantage of momentum, once the large chart has told you that the path is clear, and I want you to see it, the most current bar, that's all you need. The background is green, therefore the direction is up. The smalls are above the large, therefore I have odds favorable momentum. And price has not reached this key Fibonacci area. All of my triggers are above the previous area. I have a clear path, guys. Give me a Y in the room if you're with me. This is us having our rules met. This is literally where we make the decision that it's time to take a trade. So I'm going to open up my spreadsheet real quick, guys, and I built this for you. This is in the spreadsheet. I did 2 entry sequences in there. We're going to do the long. We're going to pretend like this is the look on the large chart. And I'm going to bring up step 1. Notice how I annotated my chart. This is how I want you guys presenting in the room as well. The first thing is that it's a strong bottom. This is a no triggers through termination. And I think this happened a couple days ago. It reverses the market. This is what we call a strong bottom. This is the precursor for the highest probability trend trade you could take. I've taken the time to label that I do have odds favorable momentum, and I've taken the time to label that price has not reached the fib. My path is clear. And guys, this annotation is key because what I'm doing is I'm reinforcing what the rules say with what the rules look like. I'm teaching my brain that this look is an advantage, that this look is an advantage. So the more time you spend typing on your charts, guys, writing those rules out, making sure that you're identifying, drawing arrows, the quicker you're going to get this. So with the rules met on my large chart, it's time to look for an entry on my small chart. I'm going to look for a couple different things because my rules for entry say that I'm going to use a limit order. I'm going to literally wait for the market to come to me. And I'm going to use that limit order to buy or sell a pullback. If you remember, the small crowd gives a little shove, right? We rely on that shove to get us to the best of the best entry. And I'm going to buy or sell a pullback at an area. We used areas on the large chart for terminations. We're going to use areas on the small chart for entry. They create a bounce point. Um, and we're going to look for fibs, we're going to look for mid bands, and we're going to look for yellow one-to-ones. And the key is that we're going to allow these areas to be inside of what we call favorable large triggers. And favorable large triggers means on your small chart, your entry chart, the large triggers and the synthetic triggers, they look just like two large triggers. The synthetics are the large triggers from your large chart. The large triggers and the synthetic triggers are overlapping. They're one on top of the other. They're very, very tight, like two snakes riding piggyback. And the tighter these two trigger lines are on each other, the large and the synthetic, the smaller your window of opportunity becomes, the smaller the location you have for those key areas to be inside of, because entries come from lines inside of favorable large triggers. By incorporating this, by embracing this, what you find is that you will have the absolute least amount of risk as you come into a trade. So favorable large triggers. We're going to use a limit order to buy or sell a pullback at an area inside of favorable large triggers. So when the large chart says go, I'm looking at my synthetics. I'm looking at my large. Sometimes the large are over the synthetics. Sometimes the synthetics are over the large. But the tighter they are on top of one another, the smaller the likely to continue spot is. You notice that price reached Fibonacci resistance. A lot of new users are going to panic, but this is where I remind you. The areas are defined on the large chart. We actually become very thankful for this area because it may create a bounce. It may give us that little pushback from the small crowd to get us to our entry. So right now I've just identified triggers and I'm looking for areas and I want to see where they're going to line up. But I need the small crowd to do their thing, and that's a reversal bar. The small crowd starts their fight with a reversal bar. Everything says up. And these yahoos want to go short. It doesn't even make sense. They're fighting everything. Thank goodness for the reversal bar, because when the reversal bar prints, it signals the beginning of the pullback. So once I see the reversal bar, and eventually it'll be before you ever see the reversal bar, I'm going to look at my favorable large triggers. I'm going to look from the top line to the lower line. Remember, the tighter they are on top of each other, the closer this range becomes. This is not where the market is likely to continue. This is where I'm going to look for areas. This is where I'm going to look for fibs, mid bands, yellow one-to-ones. And from the highest point of support to the lowest point of support inside of favorable large triggers. Guys, embrace that phrase, inside of favorable large triggers. This becomes my window of opportunity, or you Ric Flair fans will recognize it as the woo. From the mid band inside of favorable large triggers to the yellow one-to-ones inside of favorable large triggers, this is the point where the market is most likely to bounce. This is the point where the market is most likely to continue in the direction of the momentum, most likely to continue in the direction of that clear path. We've let the small crowd do their thing. We've identified the window of opportunity. And guys, the only thing to do now is to right click on your chart and activate a limit order, buy limit 2, right? And it goes right at the top of that window. Not down here at the bottom, not in the middle, not off the top of this trigger. It goes a tick or two above the highest point of support inside of favorable large triggers. Guys, these areas inside of favorable large triggers act like a brick wall to a tennis ball. These are moving averages, and price corrects to the moving averages. And when it has a bounce point inside of them, it creates that advantage for you. And we're at the top of it because the large chart had momentum. The large chart had nothing in the way. And guys, your job for the first 20 days with me, and I know that feels like an eternity, right? Because you wanted to be a millionaire by Tuesday. For your first 20 days, if you focus on getting this entry order in the right spot, if you focus on getting into the market where it's most likely to continue, what you're going to find is that 70 to 80% of the time, this is your result. The market continues in the direction of the trend. The market continues in the direction of the momentum. And the market bounces from the areas inside of favorable large triggers. Great question, Rob. You are in my head. Guys, if the window of opportunity extends from the highest point of support to the lowest point of support, let's call this the area where the market is most likely to continue. That is the area where rule number 3 is in full effect. Is everybody okay with that? We get in at the top because of all the momentum on the large chart, because there's nothing in the way at the large chart. What we've done is we have defined where the market should continue. And part of that is if it goes to the second level, we're still in a rules-based trade. And if it goes to the third level, we're in a rules-based trade. And even if you're down $200 and it's above that area of support inside of favorable large triggers, guys, the rules are still met. The advantages are still in place. Sit tight, wait for it. It's going to be okay more often than not. But if we can identify where the market should continue, where the market should go, we can also identify where the market shouldn't go. And the woo is a great way to have your initial stop in place, 4 or 5 ticks below that lowest point of support where the market shouldn't go. Because if it does go down there, you don't want to be in that trade anymore. Because rule number 3 is not met because the advantage isn't present. And guys, that's new user. More experienced users may hold on a little longer. It just depends. But if it goes beyond that window of opportunity, you're going to take a loser. Um, and anything that wins 70 to 80% of the time is obligated to lose 20 to 30% of the time. Guys, I'm not going to sell you some BS and tell you that you're going to win every trade. You're not. But what you have is a pattern that's repeatable, that's studyable, a pattern that has been proven to win more than it loses. You've created a statistical advantage. No, trust it 100%. Rob, trust it 100%, but know that for every 10 trades you take, you're going to lose 3, and that's a cost of doing business. That's all it is. It's a cost of doing business. It's the market being wrong. I don't care how you want to say it. It's a normal part of a positive equity curve. There's a million ways. Say it the way that makes you feel best about it, right? But if that stop gets hit and you had every advantage in place, I want you to say to yourself, next, next, because next time this sets up, I'm not going to miss this freaking trade because this is the trade that 70 to 80% of the time does this. So I don't want to get picky and choosy. I don't want to take one that fits the rules and not take one that fits the rules because I mess up my sample. But you've got to be able to go through and build the trust in this methodology. So Rob, David, all my new people, if you go back and circle a tail, right? We don't trade tails. But if the large chart rules are met and you circle a tail or square a tail and it lines up with support inside of favorable large triggers, well, now you know you have that high probability trend trade. Take that picture, right? Go to your spreadsheet and drop it into your favorite looks because the perfect short has odds favorable momentum. It has nothing in the way, and the market pulls back to the area of resistance right there inside of favorable large triggers. And that's what I want to catch every day. And this is a great long. Even without full-blown momentum, the clear path and the perfect entry gives the opportunity. That was somebody's long that they absolutely loved, so it went in there. This one says, this is my long. That's a 50-50. The small triggers have broken, the large triggers have not. And because I'm giving up the clear path, I'm not forfeiting momentum. I have no divergence. I have strong triggers. I have a tiny little window of opportunity, and that becomes an opportunity. So guys, you got to go back and study, and you got to take these pictures, and you've got to make it easy on yourself to recognize it in the moment. We don't trade tails. We trade pullbacks to areas inside of favorable large triggers. But dun, 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 If I scroll back, what market was that on that we were looking at? There it is right there. Let's do an entry together, guys. And C-Dub, I think you pointed this one out initially. And guys, I only want to go through the entry sequence on this, so I'm going to make a naked chart. I'm going to do nothing but triggers here because I don't want you to focus on anything other than the process of recognizing the best entry. And then from this best entry, your plan will grow. But it starts on the large chart. And let me pull back to it. Rule number one says that I must have strong triggers. Small above the large are wide, they're angled in the direction of the trend. So new users and people working on their entries right now, give me a Y if you see it on the large chart. That is without a doubt odds favorable momentum. Yes, we're all good. So the next step is making sure that I haven't reached an area, that I haven't hit something that may create a bounce. And what I'm looking at, guys, is the top of the bar. I'm looking at the top of the most current bar. Did it reach an area? Did it hit a fib? Is it at one-to-ones? Is it at a divergence high? The answer here is no. Therefore, I also have a clear path. Rules 1 and 2 are met on the large chart. I'm going to turn my attention to the smaller, faster chart. And this is what it's going to look like, guys. Small triggers are up, large triggers are up, synthetics are up. Everything is screaming up, right? And I'm looking at areas. I got one-to-ones way up here, and I got a mid-band kind of floating in the middle, and there's a Fibonacci support, but I'm waiting for the small crowd to do their thing. And that market keeps going, and I'm scared to death. Oh my gosh, it's not going to come back. I'm never going to get paid. How am I going to make money? Maybe I should jump in. What did Mark say? Oh, Mark said, when everything is screaming up, wait for the reversal bar. And look how that arrow lined up to it. Pretty cool, right? There's your reversal bar. And look how it changed. The large and the synthetics are both up. They're wide. They're angled in the direction of the trend. Guys, they're strong. At the time of the reversal bar, I'm going to draw, we'll use a circle from the top line of the triggers to the bottom line of the triggers. That's a pretty big area, isn't it? Does everybody see what I've done so far? Rob, you're getting ahead of us, right? Take it if the rules are met. Do you have odds favorable, Rob? Absolutely you do. Do you have a clear path? Absolutely you do. We waited for the reversal bar, and at the time of the reversal bar, let's not get ahead of ourselves. We've identified our favorable large triggers. They're wide, they're strong, they're angled in the direction of the trend. Guys, this is not where the market is most likely to continue. Watch how amazing this can be. From the lowest point of support inside of favorable large triggers, Rob, to the highest point of support inside of favorable large triggers. And guys, this is crude oil this morning. This tiny little area is where the market is most likely to continue. This tiny little area is your window of opportunity. I'm going to right click on my chart just above that area, and I'm going to hit buy limit 2. So John, here's your entry. I don't know where the market's trading. I hope it doesn't get hit, but it's definitely above me because it's giving me the opportunity to buy. I'm going to take this limit order and I'm going to put it 2 or 3 ticks, probably 2 ticks above the highest point of support inside of favorable large triggers. Guys, there's nothing for me to do anymore. I've activated my limit order. I've identified my window. My advantages are there. And now it's up to the small crowd to get me. They push and they push. See that little fluctuation? That's where one of you got scared and entered the market because you thought it was going without you. And all you've done is increased your risk exponentially and decreased your profit potential. They come back, and congratulations, John Tripp. Congratulations, Rob. You're in a long trade. You're in a long trade with the advantage of momentum, with the advantage of a clear path, with the advantage of having entered where the market is most likely to continue. Once I'm in this trade, my stop is going to go somewhere down here, about 4 or 5 ticks where the market shouldn't go, right? And I'm probably risking about $100 per contract. Is everybody with me so far? Guys, this is your picture. This is the picture that you should take. and you should upload to screencast and you should open up your spreadsheet and you should drop it in there. Create a link, drop it in, and label it. Say, this is the perfect long. I never want to miss it. I always want to take it because the rules are met. And then let's see what happens. We're in the market and it pushes against us. Are we panicking? Or are we like, it's cool? We're still above those areas of support. They're still inside of favorable large triggers. Some of you will say, but Mark, my small triggers turned against me. Momentum is defined on the large chart. You're going to get this to get you back to the spot. And then let's see what happens. Now it's reached the one-to-ones, guys. We got in because of all the momentum and the clear path. We didn't want to mess with it. We wanted to make sure that we got it. And we're down 50 bucks, 25 bucks. Not a lot, but we're down a couple ticks. For some of you, that's a huge mental thing. You're like, oh, I can't stand it. I'm going to get out. And you jump ship and you're like, whew, I only lost 2 ticks. And then it gives you a reversal bar in the direction of the trade, guys. Your initial stop, Rob, was down here, right? You got in at 89, your stop's down here at 79, and then the reversal bar prints. And I'm going to move my stop 2 ticks below it, which means that I literally have 5 ticks of risk on this trade. I've entered with momentum, I've entered with a clear path, I've entered with the pullback to the area inside of favorable large triggers, and let me slide this circle right over on that. Tube sound, thank you. Hold on one second. Let me see if I disconnected. It says I'm connected. Guys, am I sounding like I'm in a bucket for everybody or just C-Dub? We're good. C-Dub, it may be you, brother. 5 by 5, David. All right. So guys, give me a why in the room, please. Do you see how we entered where it's most likely to continue? The best of the best. We didn't get a tail over here. We don't know if the tail is going to form. If that market smashes through here, we'll never get a tail. We'll just get a down bar. But with all that momentum and that clear path and everything that says up, the market doesn't even blink for $250 worth of profit all the way up. What I want you guys to do is I want you to commit yourself to the idea. Give yourself the idea that it's okay to be new. Do you see where the circle lined up? Right at the bottom of the tail, right? We don't have to trade the bottom of the tail. We don't have to wait for the tail to form. Guys, we're getting in at the point where it's most likely to form. This is your high probability trend trade. This is your entry. This is your focus for 20 days. Learn how to get into the market where the advantages are. Learn how to get in at the absolute best of the best spot. I'm going to give you a checklist. I give the checklist every day, and I'm going to get my indicators back on there while I talk about the checklists. This is a trend trade checklist, guys. This is a high probability trend trade checklist. It is defined to get you into the market, nothing more. It is defined to get you into the market with all of the advantages. So market coming from a good top or bottom. Guys, if you need help on termination conditions, if you need just that little refresher, like Mark went through it, I'm just not sure. The video on this checklist is outstanding. It's my brother talking for about 40 minutes on tops and bottom edges, when areas are likely to hold, when they're likely to break. It is a gold mine for the new user. Is the market coming from a good top or bottom, from an area that reversed the market? If it's not, you can still take the trade. It just means you have to be aware of those divergences as they print. Do you have odds favorable momentum on both charts? I'm giving you the best of the best scenario. No termination conditions on the large chart and an area inside of favorable large triggers on the small chart. Notice that inside of favorable large triggers is bold. Because guys, that's such a key. The market corrects to the triggers typically, and when you give them a bounce area inside of them, it creates an advantage. And then Dwight, if your bounce area is beyond them, well, then you've already gone past your correction point. But if it's a tick or two in front of them, I'll typically take that trade because it hasn't gotten to that point of correction. If you follow this checklist to the letter, guys, I've never had anybody in the history of it do worse than 70%. Most people do closer to 83, 90, but I'm not going to give you those expectations because you're going to make mistakes. If you can follow this to the letter as a brand new user, this is a trade that typically wins more than it loses. This is a trade that creates confidence through the memory of success. This is actually an outstanding way to make money while you become a chart reader. For those of you that are visual, I've got the exact same checklist, but I've taken pictures from the resource material for you. Is the market coming from a good top or bottom? Here's a picture of a termination that creates a full reversal. So on that same token, guys, would we consider this pivot from nowhere a strong top or bottom? What do you think? Not a termination that reverses the market, termination that reverses the market. One is not. Do you have odds favorable momentum? Small's above the large, guys. It's listed there. It gives you odds favorable for the market to continue up. And then the flip side is weak, and it describes anything can happen up or down. You're associating the words of your rules, the words of the advantages with the looks on your chart. Price reaches resistance, no triggers, break, no trade. The path isn't clear. We're using the language. Smalls above, large below, odds favorable, potential to clear, not a clear path, can't be a high probability trade. Small and large through the area, now the area is broken, the path is clear. And then windows of opportunity go in both directions. And then Dwight, this is a picture that I was going to share. When we talk about areas that aren't quite inside of favorable large triggers, when you're inside of the large triggers, you're literally at the correction point for the moving average. Price likes to correct, right? When you are beyond those large triggers, you're no longer in a good position. You're no longer in that position where you have an advantage. And the same is true here. Notice that outside of the correction point, we're not looking for our trades there anymore. We're just too far past where the good things happen. Sometimes you'll get a mid-band Dwight, a tick or two above, right? Sometimes you'll get a fib, a tick or two above. Sometimes you'll get a yellow 1-to-1, a tick or two above. I love it because you're still on the path to correction. So as you begin to bend rules a little bit, guys, a little bit below the triggers for a short, it's all right. You know where your stop goes. Same thing for longs. But once you get beyond, things typically go a little wonky if everything isn't perfect. So this one's in the room too. I've dropped both of these checklists in the room. Um, Look at that, 50-50 trade, right? Small's above the large are wide, they're angled in the direction of the trend. I don't have a clear path, and I have a loss of momentum, which means that if I just go back to advantages, I've forfeited rule number 2, and I'm starting to give up a little bit on rule number 1. The plan I'm about to give you is designed to optimize your chances of success, guys. No worries, John. We'll go through it one more time, and I'll tell you what. Let's do this. Bum, bum, bum. Let me find an awesome example that's easy to read. Here we go. All right, so we're going to start right here on the right-hand side. John, I want you to pretend like this is the live market. And this is your most current bar. And the market comes down, and we're using the 71.52 fib. Price reaches the area. That's the beginning. So, John, once price reaches this area, it is creating the potential for decisions. Buyers may take over, sellers may give up, there may be a fight. We just don't know what's going to happen. So when price reaches the area, I'm going to sit on my hands and I'm going to do nothing. I'm just going to wait and see what happens. Is that good, everybody? As the market moves down, my small triggers break through the same area, but my large triggers haven't yet. 50% of my trigger lines are below the area. 50% of my trigger lines are above the area, which means that this area at 52 has the potential to break. With all of that momentum, This area might break, but it's not broken yet because it's not broken. The path isn't clear until both my small and my large triggers clear the area. So it reaches the area. It's okay to sit on your hands and do nothing. Just wait and see what's going to happen. When the smalls break through, it has the potential to break, but it's not broken yet. And then when the large get below, now the area is considered broken. Now the path is clear, and now I'm looking for one of those pullbacks, and I don't know if it happened. It doesn't look like it did, but the momentum carries it. So even though the area broke, even though the momentum was there, we never got one of those pullbacks for a potential entry. Does that help a little bit, John? But you can literally scroll back and you could do this over and over, right? If this is the fib in question, sit on your hands, do nothing. That fib has the potential to break. Now the fib is broken. So here we had the potential to break. The smalls are above, the large are below. They're trying to break through, but until it gets above it, John, it's not a clear path. Mario, there is no we. For a high probability trend trade, it takes a pullback to an area inside of favorable large triggers. Because if you got in just above that mid band, your risk is virtually nothing. But do you see how the area hasn't broken yet, guys? We're still not in a clear path. I've already had one loss of momentum. This is a medium probability scenario. If you chose to take it, 7152 represents your trouble spot. 7152 represents the spot where it's okay to get paid a little bit. It's okay to get to break even because the path isn't clear. It's not high probability. And that's what this next gift is designed for. So this is the trading plan. And John, I know that you're on day one, brother. To be a little confused is okay. It's literally like drinking from a fire hose on day one. Every day it gets a little better. Don't stop asking questions. Every day the clarity comes. Don't stop asking questions. And that's the key. And then Rob, I'm gonna cover yours, clear path, no divergence. Let's talk about it. This is the KISS plan, guys. This is the keep it simple sunshine plan. This is the plan that is going to be your stepping stone. This is going to keep you focused, optimize your chances of success on the high probability trend trade and that 50-50 trade, that trade where the areas have the potential to break. Guys, this is by no means the end of the road for you. This is very much, oh, you can learn this and grow, Andy. You're not going to stop learning for your first 10 years, guys. But what it does is it keeps you focused on the best of the best, guys. And this plan came to be, let me share a little bit for you guys that are new. This plan came to be, I had a gentleman call me one day and he said, Mark, I can't find a trade. I can't catch a move to save my life. I'm looking for the high probability trend trade. I'm looking for the 50-50 trade. I'm looking for an edge trade. I'm looking for an HVA trade. I'm looking for a counter trend trade. I'm looking to use the gap theory to take a trade. And this guy had like 173 things that he was looking for, and his brain couldn't figure it out. And he was catching nothing but the losers because he was trading in partials. And I said, you know what? Let's focus. Let's refine it down to the two best trades that you can take. And it's going to require a little patience, but this is going to optimize your chances of success. Um, and we just put them on it was almost like being on a diet. I'm going to restrict your trading calories here. Focus on the best of the best. And what it did is it taught him to refocus, to speak in terms of advantages, and it set him right. And people that tell me that they can't find trades in the market, when we keep them focused on the simple, they suddenly find them. And I've had people in their first 30 days with Nexgen use this plan and get funded on those prop firms and get to the point to where they could trade other people's money. I had guys winning 75, 78, 83% of the time using this very simple plan, but it requires a level of patience. Um, your simulation, your study, your feedback, your continuous practice, you will create a plan tailored to your personal goals, guys. You're going to create your plan through repetition, through recognition. But this gives you something to cling to until you have those capabilities. Your plan will come based on your experience reading the indicators, right? So, Mario, you asked, do we only trade on pullbacks? Well, there is no we, because what some people wait for pullbacks, and then I have other people that have been with me for a while that take advantage of a clear path and momentum, and they don't even wait for a pullback. They capitalize quickly right in the middle. So Ron has developed a plan based on his experience reading the indicators. There's a million ways to do this, guys. You just have to find the one that works best for you. You have to find the one that suits your needs, the one that you recognize the easiest. And Mario, I'm going to tell you right now, I tried to take Ron's trade for about 3 months and it never clicked. And it only recently worked its way into my plan. And I had to go back and I had to take 100 pictures of it and I had to study it and I had to practice it. So don't try to do what other people do, guys. Keep it simple, master the simple, and then move on. So your simple plan for consistency starts with never fight the large chart direction. Um, Never fight the large chart triggers. This will eliminate 60 to 70% of the problems that new users face, guys. Just don't fight. Um, my brother wrote a bestseller. It's an awesome book, and it's such a good read. And it's called How to Commit Financial Suicide in One Easy Step. Trading against strong triggers is one of the biggest things, and this is tongue in cheek, right? Trading in determination conditions. These are the two biggest problems that new users face. So he wrote this book to remind you it's okay to not be in every move. Um, where is our plan? There we go. Define your entries. Get good at your entries. Learn how to get into the market where the market is most likely to continue. Because when you do this, it creates the least amount of risk. It creates the highest profit potential. And really, and like Ron said, trend trades are mandatory. They teach you how to learn. They teach you how to read your indicators. They teach you to become chart readers. Define your entries. Start taking pictures, guys. Commit to at least 15 pictures a day. Every time you see a trade, every time it fits the rules. Maybe even somebody posts one in the room. Steal it. It's okay. Because what you're doing is you're creating recognition through repetition. And then once you get into the trade, well, then you have to manage it. And that's the second piece of the puzzle. But remember that you're getting into trades because of the first two rules. You're getting into the trade because of the odds favorable momentum, and you're getting into the trade because of the clear path. So your management plan is going to be just as pragmatic and mechanical and opinionless as your entry plan. It's going to be if then. Um, and then once again, that magic phrase, you will craft a plan tailored to your personal goals based on your experience reading the indicator. Your management plan is going to grow as you grow. As you begin to recognize patterns, as you begin to trust momentum, as you begin to see these areas and where the market's likely to go, you will begin holding for bigger moves and managing more effectively. But until you can do that, keep it mechanical, keep it focused, right? And the most focused way to do it is to always let the rules be met. Always take the best of the best entry. Get into the market where the market is most likely to continue, which means that once you can define the window of opportunity, the high probability trend trade teaches you to do this, you also understand where the market shouldn't go. And that's where your stop goes, guys. You have these ATM strategies put into place, and it says 12 ticks for crude oil or 12 ticks for the S&P. That is not the stop. The stop is where the market shouldn't go. It just gives you time to react. Once you're in the market, you're either going to get stopped out, and just go ahead and be cool with that, guys. Let it hit your stop on sim for a while. Get accustomed to the idea that in your first 100 trades, if they're all high probability trend trades, you're probably going to lose 30 of them. But that's okay. At 70% winners, it's hard to not make money. Or the markets are going to bless you with a reversal bar in the direction of the trade. And if you get that reversal bar in the direction of the trade, this is your opportunity to reduce your risk, to take that stop from outside of the window of opportunity and put it 2 ticks above that reversal bar, or 2 ticks below a reversal bar if it's a long trade. And at this point, once again, you're just going to roll back from the computer. You're going to take your hands off the mouse And you're going to say to yourself, they're either going to get my stop and it's going to be a tiny little loss, and I don't care because I had so many advantages, they're going to have to come get me. Or all that momentum and a clear path and that perfect bounce point is going to push you to your first target. For the new users in the KISS plan, your first target is $100. And for some of you, that's just not enough money. And you know what? That's something that you're going to have to work through. But $100 does a world of good for the new trader. It creates confidence because you were just successful. NinjaTrader told you that you just got paid. You took the perfect entry and it did everything that you hoped it would, and you feel awesome, and the dopamine hits, and the serotonin flows, and the palms dry up, and you have $100 that nobody can take from you. And then you're going to move your stop to break even. And guys, this break even stop is going to get hit a lot. It really is because it's not the best stop. But when you learn to read indicators, you'll know where the appropriate stops are. But what this does for the new user, once again, is it gives you the peace of mind and the calm. You've already been paid, you have nothing to lose, and the large chart told you that it was likely to go down, and the large chart said that there was nothing in the way, and it makes it easier to hold for the second target. And the second target is only pushed out there at $200, guys. So one trade on a two lot, if you hit both targets, you just made $300. And I'm telling you right now, it's weird that $100 to the average user, they're like, it's just $100. But the second it goes to $300, suddenly it's full of kick-assery. You're like, yeah, I just made $300. Guys, get hit break even three times, right? That's $300. And if that's the best you can do every day for a whole year, every trading day, guys, you just had a $72,000 year based on $300, $150 a contract. And the idea is that you are going to take this high probability trend trade. You're going to take this best of the best. Let me make that a little bit smaller. And you're going to commit to it until it becomes easy. And then once the high probability trend trade becomes easy, once the chart reads become easy, and I'm telling you, like a week, honest to goodness, if you're taking pictures, if you're participating, you're going to be able to recognize it within a week. You're not going to master it in a week, but you're going to know where you should be getting in if you keep it simple. Your management is just as opinionless as your entries. You're just going to let it happen. Guys, when you're starting out, you're going to move stops all over the place. You're going to be scared to death to lose this monopoly money. I want you to just tell yourself, let it happen. Let my stops get hit. Let my targets get hit. Stop moving the darn indicators. And then once you're good at this and you're comfortable with this and you feel pretty good about chart reading, move on to that 50-50 trade, that area with the potential to break trade. One area not broken. Remember that I said this is to optimize your chances of success. This is not the only way to take a 50-50 trade, guys, but the best way is with only one area not broken. If you have 4 or 5 areas that aren't broken yet, well, that's a lot of work for the market to do. That's a lot of decision-making points. You must have odds favorable momentum on the large chart. You must have the best of the best look, or that area doesn't even have the potential to break. Your small should be outside of the large on the 5-1. We're already giving up the clear path. Do not forfeit momentum. There should be no divergence on the 5-1. Divergence is a visual indication that momentum is waning. There should be no divergence. And it should be from a good top or bottom. Tell you right now, as you grow, you might skip out on the divergence if it's from a good top or bottom. I never go the other direction though. And then just enter at the area, the same entry rules. Notice that it reminds you, divergence, no trade. And then your management is a little different because it's not a high probability trend trade, it's a medium probability trade. Has to be managed assertively, which means that your initial stop's still outside of the window of opportunity. You're still using the reversal bar, but if divergence prints, the hell out of the trade. Divergence is a 50-50 killer more often than it isn't. $100 on the first contract again, or at the first trouble spot. So let's go back to that crude oil. That was your 50-50 over here. Your first trouble spot was the area that didn't break. And look what happened. Look at the bounce that came off of it. And then a third divergence. And it pushes even lower and stops everyone out, those jerks. And then it goes up. Your KISS plan puts your thinking cap on. It gets you managing assertively. And then you're looking for quick profits too. So if you had a good bottom, right? Termination, full reversal, odds favorable, potential to break, and you entered at 41, you made $100 into the trouble spot. You went break even into the trouble spot. You got stopped out break even. You made $100, missed the dance, and waited for the next best option. So, guys, this KISS plan, you're not obligated to use it. You're not obligated by any means to do anything that I ever say. Trading is your business, it's not mine. My business is getting you to read the indicators, but I want you to see something because simplicity yields results, guys. If you take all of the fluff, all the educational mumbo jumbo off of this, two trades with a management plan fits on 2/3 of a piece of paper. Print this out, use it, make it your Bible, focus on it. And what it'll do is it'll keep you from chasing everything. It'll have you focused on taking the absolute best. And then as you grow, you're going to be able to catch more and more. And sometimes it's not your money. Sometimes it doesn't get there. And you have to be okay with that, right? You have to be okay with the idea that every trade isn't yours. You have to be okay with the idea that sometimes it isn't perfect, that sometimes termination conditions are going to win, and sometimes termination conditions going to win. So, Paul, it was still lower on March. Do you know how to do a market analyzer? So if you ever come in late, guys, and you get that prompt about crude oil, always run the analyzer. It'll help you. I did one right before class, being lazy. So that was it right before class. And it was almost 50-50. And then right when I woke up, it was pretty close to 50-50 as well. Um, so crude oil can have a little indecision when you only have half the volume. Guys, that's my first hour. That was the first hour and 40 because I know that I have new people. And it's important to me that you guys are getting this very basic foundation. I'm going to encourage you to keep it as simple as you possibly can. Think about it in terms of, I don't know, remember mathematics. You start out with basic addition. And John, I think I did, but let me give it just in case I didn't. Start with basic addition, guys. Learn how to know which direction you're trading. It's going to eliminate a lot of mistakes. And then from basic addition, learn subtraction. Be able to recognize odds favorable momentum. Learn to trust odds favorable momentum. Go back and do that. Scroll back 10 days on 3 different markets and look at how many times strong triggers push the market in the direction of the trend. Develop trust. And then once you're good with these two, start working on your termination conditions. Go back and circle them. Post them in the room. Say, hey, Mark, price reached this area and none of the triggers broke. I see this as a termination. Am I reading it correctly? Absolutely. Guys, most people don't use the room the way it's intended. It isn't just to show off. It isn't to show your winners. Guys, this isn't your grandma's refrigerator, right? We're not just posting everything that you do wonderful and not posting the bad report card up there. This is an area for feedback to make sure that you know how to read your indicators. So you should be taking pictures of odds favorable momentum as you're learning it. Post it in the room. Mark, I just want to make sure I have this right. Take pictures of termination conditions in the room. Post them. Mark, I want to make sure that I'm reading this correctly. My financial independence depends on it. And then ultimately you get to algebra, which is the entries. The average user will recognize direction and momentum on the first day and have absolutely no problem with it. That same user will fight momentum by the third day because they're focused on termination conditions. They can't put it all together at the same time. By the end of the first week, they're pretty good at looking for their setup, and then they've got to refine their entry. And this is what takes just a little bit longer, guys. And the more you post in your room, the easier it becomes. Because when you see these entries, when the market isn't moving, it becomes easier to open up your chart and watch this. I have weak triggers at a termination condition. I'm not taking the long. Period. My rules aren't met. I have weak triggers with a clear path, but none of my areas are inside of favorable large triggers. I'm just not sure how I feel about it. But right here I have smalls outside a little bit and a clear path, and it pulls right back to support inside of favorable large triggers. That one would have been my trade. I have small triggers trying, but I'm into resistance, and absolutely none of my triggers are broken. I'm into a termination condition. I know that I don't have a clear path. My rules aren't met. Guys, that's how quickly your analysis can happen. That's how quickly you can put it together. And once it happens that fast, start looking for more trades if you want. But until you can do it that quickly, sit on your hands and relax, guys. It's a marathon, not a sprint. I'm going to go stretch my legs. I'll be back in 5 minutes. That was the longest first hour ever. When I come back, we're going to look at the charts that were posted. We're going to answer the questions that I missed. And if you have more questions, post them in the room. If you have pictures, post them in the room. Remember, guys, every time you post in the room, I can't stress this enough. Tell me why. Tell me why you did what you did so that we can work together to do it better. Don't make me guess. Don't make me imagine what's going on in your head. I'll be back in 5, guys. All right, let's get at it. So, for those of you that are brand new, that first hour lasted longer than the first hour typically does. I know that I've got new users. I know that you're just trying to learn the software. So, I wanted to make sure that I went through and gave you as much as I possibly could in the first hour, that I slowed it down a little bit, gave a lot of examples, gave you the opportunity. Because really the rules are where it's at. Building that foundation is where it's at. And I don't ever want you to miss out on it. But what's cool is how many of you in this room said that price reached that area. And because it reached the area and none of the triggers broke, I knew that it was a termination condition, which means that my path wasn't clear, which means that even though the market may go up, I don't have a clear path. So it's really more of a hope that it goes up. It's not, it is going up, if that makes sense. Um, and man, crude oil loves this pattern. Strong triggers into resistance, push all the way back to support, and then come and retest the area. And it's such a popular pattern. And patterns are all we do, guys. Patterns are all that we look at. That if you go to the user guide, if you go to the tutorial page and you open it up and you look at the same picture that we did this morning, this is from crude oil in 2021. Triggers into resistance, back down to support, back to resistance with weak triggers, right? It's just a pattern. It's a pattern that repeats itself. So I'm going to go through it. I'm going to start looking at the pictures that you guys posted. There weren't a whole bunch today, but there were. I do them in order, and I do have to scroll up to the top to find them. If I miss a picture that you posted, please let me know. I never skip them intentionally. I don't think, this one has no value. I don't want to talk about it. Um, and sometimes I miss. So I want to make sure that I don't miss. So I'm going to go up to the very, very top, and it looks like Ron got us going. Um, and Ron says, don't fight the large chart because Mark says so. Has nothing to do with Mark saying so. But this is one of those instances where people are using their ability to read charts to formulate a plan rather than waiting for the high probability trend trade. Ron says that when everything is up, when everything is strong, and the backside of his bar clears trouble, he'll use those strong triggers on the small chart and he'll try to just take quick profits. And that was quick in, quick out, and it's a base hit. And it's on the premise that you don't have to hit a home run every time, guys. If you are consistently taking profits, then you're doing it right. And if it takes two trades or eight trades, $1,000 in your pocket is $1,000 in your pocket. So good stuff. All right, Andy, let's see what you got, my friend. Andy says, I tried the long here, but I got stopped out. I see momentum. First rule met, not really coming from the best bottom. That yellow 1-to-1 probably got me. So, um, Andy, let's talk about it. And I like that because you told me everything that was on your mind. And I think that's such a big part of getting to where you want to be. So let's look at the big picture. Um, I love the look, right? Small's above the large. The large are turning. They're starting to get wide. Um, but then let's talk about two different things. The first thing is that do you see how the path isn't clear? The large triggers have not gotten above that support. So while it looks like they're trying to get there, they just haven't yet. So it's not quite a clear path. So best case scenario is we have to call this a 50-50. And a 50-50 with two divergences above it, man, that's kind of a bad look. That's that if you're trading the KISS plan, that's a 100% off limits trade. Um, but here's the other thing. Do you notice how on your chart, um, do you notice how on your chart, Andy, there's your large triggers with a mid band in it, right? And this was crude oil this morning, I believe. I want to go back and I want to talk about favorable large triggers. And I want to show you the picture of favorable large triggers. And I'll pull it off of the spreadsheet. I've got a picture in here called split triggers. And guys, what we run into and why having those favorable large triggers is such an advantage because price likes to go back to them. Price loves to pull back to those triggers. When they're one on top of the other, when they're very clear, when they're focused and those areas fall within, you've got a very small window of opportunity. And Andy, if you look at your picture, your synthetics are all the way down here at 70, which means that you don't know if it's going to be the mid band or if it's going to come back and maybe hit those synthetics down here. Those split triggers create a ginormous window of opportunity. And that huge window of opportunity, when you don't have a clear path, when you're fighting divergences, is just detrimental. And you're losing the advantages. So it's not that the yellow one-to-one got you. It definitely provided a bounce spot down. But two divergences, not a clear path, and a huge gap back to your synthetic triggers was kind of a deal breaker. Does that make sense, Andy? Are you in here? I hope. And guys, this is what we do. We look at the charts, we talk back to the lessons. You had the right idea. That termination was starting to reverse. You just had to kind of let everything tighten up a little bit. I like the direction you were going with it, and I think that the read was a good read. It just needed a little bit of patience to get you where you needed to be. Nice job. All right, we're going to get to the next picture. GWC Trader. And John, yeah, close but not enough. John, did the entry rules help you a little bit on that refinement, how you can recognize on the 5-1, the one bar on the large chart? I forgot to address that after entries. I wanted to make sure that that cleared up for you. Awesome. Cool. And I love this. GWC says, with this much momentum and everything going up, look at his entry, ladies and gentlemen. And then just quick profits. But this is everything that we talk about. That's actually the example that we did in class together. And you'll notice that GWC caught it real time, where we caught it just, after the fact. We could do it. It is, John, and I'll do it in here as well. But let me show you one of the cool things. Right here, the software user guide. This discusses almost everything. But are you on NinjaTrader 8, I'm assuming? All the new folks are, right? I'm going to open up my NinjaTrader 8 and we'll go through. Yeah, you should be. I think Ron and I are the only ones that still use 7 every now and then. I'm going to open mine up in the background real quick so that we can look at it. And I'll go through the whole thing, moving stops and targets. We'll take care of all that because that's what class is for. Class is for getting the new people exactly where they need to be, along with getting the feedback to the more versed users. But GWC, absolutely beautiful. Everything about it. And mine is trying to open up a NASDAQ real quick. Let me close that down. And I'm going to create a chart, John. Let me go through a couple pictures and then we are going to go through and we'll talk about entering, we'll talk about stop placement, movement, all that stuff. I just want to get NinjaTrader 8 up so that you can see it on what you're looking at, make it a little easier. And GWC, if you're in here, high five yourself. That was absolutely beautiful. Hey, Ed. All right, Ed. Everything says down, and you went down, right? The path was clear, and you let it kind of sort itself out. You get in, everything says down, you take quick profits, and then you run the tightest stop ever, and it gets you on that, but you're making money. You are definitely working harder, not smarter. But I like the look at. I love that the large chart led the way. I think it's awesome that you are focusing on letting the large chart lead the way. That's nice to see. And then John, absolutely. You are in NinjaTrader 8. Odds favorable. Anything can happen. Odds favorable. Freaking perfect. Absolutely perfect. Nicely done. Day one. He's already. John, you get the microphone tomorrow. You're teaching. Good job, bud. I get excited when you guys do well so quickly. Um, and then Dwight, this is where you were asking about the mid bands, right? You were asking about, well, what if the area is kind of outside of the favorable large triggers? I wanted to discuss this. Um, because there's more to this picture than just areas outside. So it all starts without having the best momentum, right? So we have those anything can happens. And I think this is the key, guys. And if you go through the process and you talk to yourself, anything can happen, right? What does that mean? That means that we could get a deeper push, right, Dwight? Because you don't have that super strong momentum pushing it down. And then you couple it with even more loss of momentum, and you have to say to yourself, all right, I don't have any areas inside of favorable large triggers. Always start on the large chart. I don't have any areas inside of favorable large triggers. Do you see that? So rule number 3 will never be met on this pullback. Rule number 1 wasn't met on this pullback. But I want you to go through the verbiage on rule number 2. And I think this is the other side of termination conditions that becomes so helpful. If price reaches an area, in this case resistance, and all my triggers are below, isn't that area likely to stop the market? Doesn't that area have the potential to stop thing colds to stop it? It's just the opposite, right? We know that if price reaches support and the triggers don't break, it may bounce. Doesn't it make sense that if it comes back to resistance, it may bounce as well? And this is going a little advanced. So what you've got is you've got this fib that may hold, Dwight. You've got this fib, this midband that may hold. This is where, when things aren't perfect, you can wait for, let's say, a reversal bar. Something that signals, hey, this market is doing what I anticipate it to do off of resistance. And if you never get the reversal bar, if for some reason this loss of momentum pushes it all the way back up to here or even up to here, then you never really have to take the trade. So this creates an opportunity for you to get in just a little bit better, right? A little bit off the area. And then you do ultimately get 3 divergences. And for me, that's a termination condition coupled with a loss of momentum, no areas inside. I'm not sure that I'm still in the market for a short trade here. There's been too much change. Too much change. Does that make sense, Dwight? Does that help a little bit? So, John, you said right now in crude. Oh, that's the S&P. Let me go to crude. So let's go through all the rules. So, John, the smalls are a little above, right? But they're not odds favorable. I'm above support. All of my triggers are above support or above resistance. So resistance is broken and now it's support. The path is clear, but the momentum isn't the best. Does that make sense? We're just trying to go through the advantages. And then favorable large triggers means that both are wide and angled in the direction of the trade. See how your large triggers are just flat. Your synthetics are up, and the only areas that you have are below there, right? They're all below, not inside of what we call favorable large triggers. John, this is an absolutely amazing sit on your hands and wait pattern. And what's kind of cool is look at what's happening at the fib. Look at the action on the small chart right at that Fibonacci area, right at that decision-making point. I don't really have the momentum to make it scream. I don't really have any areas inside of favorable large triggers. So I'm in a little bit of a holding pattern. And this is what I'm holding for, John. I'm either waiting for it to push down without the strength, or I'm waiting for everything over here to kind of line up, to get strong, to look, and then I'll look for an opportunity. Does that make sense? Perfect. That's a great read. You identified that the rules weren't met, and you said, you know what? I'm going to have coffee instead of hope. You have no idea how difficult that is. But see, I love it. Such a good. And we'll come back to it, and we'll see what happens in that area. And then, Dwight, I hope that was helpful. You got to do the full read, but there has to be a point where you're like, man, I can't give any more away. I can't give any more advantages away. And I think you did a great job with that on that one. If you caught the first one from the fib, Still probably a manage out trade. And then another chart read, guys. When price reaches support, every one of the triggers stays above it. Multiple divergences in the same spot. Ron's developed a plan that gets him back up to the trouble spot. Absolutely, John. I just wanted to go through a couple of the pictures that people have posted, um, and then I got you. I'm almost there, I promise. Joel, 50-50, divergence prints. You choose not to take it. Way to follow rules, Joel. That's hard to do, and you did it perfect. All right, I'm actually going to build a new chart, John. So what we're going to do is we're going to go through um, everything on one chart. Sorry, guys, I am multitasking. And if you ask my wife, she will tell you that is not my forte. All right, I'm building a chart to the side. I know how to annotate my charts now. Watch out. I love it, Rob. Annotate the hell out of them every day, everything. All right, C-dub. Not the gap theory. Maybe the gap theory on the 21. I'm not sure because of the reversal bar mark. I don't see a reversal bar marker. But just straight up termination conditions over here on the S&P. Rule number 2 is not met. Not even a little bit. And I can't see a reversal bar marker, so I'm not sure whether or not that is the gap theory or not. It did go up. Cool. Does it change the fact that that was a termination condition? 1, 2, 3 times, pushed it below beyond everything that was ugly, and then it went up. If you're willing to run huge stops and sit through all the nonsense, then great. But that's not gap theory for the win. That's not the gap theory. So um, we're going to help John for a second, and then we're going to do a gap theory lesson, C-Dub. All right, John. So this is just a 5-1 chart on crude oil. That's all it is. So the first thing is that you have ATM strategies off to the side. Are you with me? And this is for anybody that needs the help. And let me make sure that I'm in global simulation mode so I don't accidentally hit a live account. So these are your ATM strategies. Anytime it starts with a 1, you're trading 1 contract, 2 is 2 contracts, 4, 6. And then lot is just a way of saying, I don't know if you know this or not, a 1 lot is 1 contract, 2 lot is 2 contracts. So you'll hear that verbiage. The next number is where your stop loss is set. So for example, a 1 lot, 1220. That means that I'm trading 1 contract. My initial stop is 12 ticks, and my profit target will show up at 20. So, whoops, I'm going to try to edit that real quick. And this is what it looks like on here. Order quantity 1. The parameter is ticks, so your stop loss is in ticks, not points. 1 contract, 12 ticks, profits 20. So what that means is if, for example, I sell the market right here and just hit sell market, my stop loss is 12 ticks, and then my profit target is 30 ticks in the distance. And I'm not saying that this is the correct trade. I don't have a large chart, guys. Don't take this trade because you saw me enter it. I'm not calling trades. We're doing a little bit on this. Yeah, I have to throw the disclaimer out there. So if I want to move my stop, I can click the red line. I can move it anywhere I want, really. But the original stop stays in place until I click again. And now my stop is up here. The same is true with the targets. I can push my targets anywhere I want. I can make them bigger. I can make them smaller. If I need to exit the trade, if I get in and I'm like, oh my gosh, I broke my rules, I can hit close. And then when you have two contracts come down, we'll do two for 12, 15, and 20. If I sell the market again, my stop has two contracts, two sells, buy stop right there, right? This is my stop. And I can move it above the pivot wherever I want. And now I have two contracts. So maybe I want to take my first profit at this divergence low. Maybe I want to take my second profit at this divergence low. And then what I can do is when my first contract gets filled, I have one left. And if it hits my stop, it'll pull me out of the position. There we go. The other thing that you can do to make it helpful, John, is if you right click on your small chart and go to data series, watch over here where we took the trades, scroll all the way down and click on text and marker. And what this will do for you is it'll show you where you entered and where you exited. So you can go through, and when you show me this picture, we can talk about your entries. We can talk about your stop placement. We can talk about all that good stuff. That's okay. So I right click and I go to data series. And then from data series, I'm scrolling all the way to the bottom. And under plot executions, I want to see both text and marker. And you only have to do it on your small chart. Do it on your entry chart. But what this does for me, John, is let's say that you show me the perfect short. You show me both charts, right? And one chart is super strong and clear path, and the other chart, you're looking for your entry. And let's say, just hypothetically, the rules are met for you to enter right here, right? But you show me an entry up here, and I can see it on your chart. We can talk about that. And if I see a stop just above it, we can talk about that. So showing me your entries, showing me your exits, what it does is it really sets the stage for you to be able to get that feedback not only on entries and exits, but also the whole thing. And then one more thing that I want to talk about is taking pictures. Let me get all of the drawing stuff off of here. And then check it out. They fought, and now everything is starting to line up again. You didn't have to get caught in the fight. When you take a picture, are you using the capture software? Or do you have Snagit, John? And again, this is for everybody. How are you taking pictures? Screenshots? Cool. Can I give you the easiest way to do it? And this should be on your computer, to be honest with you. It's part of the loading process. So if you want to go to your search bar, type in TechSmith. You should see that app if you want to try that real quick. Um, cool. So open it up for me. And then once you open it, you're going to see that icon down there. And TechSmith Capture looks like this. And this is about the easiest tool that you'll ever use. But this is the perfect way for us to have conversations, everybody. Let me know when you have it up. And what I'll do is I'll go through the whole process. And we will talk about what we see. No worries. I'll tell you what, if you just want to pay attention on this one, what I'll do is go through it. You're going to be able to do it. I can already tell you're a sharp guy. But here's the link to to the capture software to posting in the room. But I want to show one trick that's so important because everything that we do is large chart, small chart. Everything we do is advantages here, entries here. So if you click your capture button, it's a click and drag tool. If you hover over just one chart, it only gives you one chart's worth of information. And we really want to see both. So guys, always left click in the upper left-hand corner and drag it all the way down to the right. And then when you do that, it's going to give you the opportunity to either take a picture or capture a video. For you guys that are really fine tuning, refining, getting into those final steps before you think you're ready to go live, or maybe you're finding yourself breaking rules, click the video right before you take a trade and talk yourself through what you're doing. Talk yourself through the advantages, talk yourself through the entry, talk yourself through the targets. And as you manage it, stay vocal. You will be absolutely floored at how you either talk yourself into staying into a bad trade or talk yourself into getting out of a good trade, or just how you're just not sure what's happening and you'll hear the hope in your voice. Or maybe you're doing it perfect. You're like, this hasn't changed. This is great, blah, blah, blah. Use the video feature a couple times. It's pretty cool. But once I capture the image, it gives me both charts. It gives me the large chart and the small chart. Things that I really appreciate from you guys is give me the timestamps on both. Give me the price bars on both. And that way what I can do is I can line it up. I can line up your advantages and your entries. And then once you do that, there's an arrow, there's a call out, there's a shape, there's a highlight. Everything is click and drag. You have to left click and pull to make that arrow go somewhere. So what I encourage you guys to do is the first thing, go to rule 1. Draw an arrow to your trigger lines. Use the call out button, left click down and create a box. And write, do I have strong triggers, right? Put a question mark and then answer yourself. Yes. Yes, I do. I do have strong triggers. And then draw an arrow to the top of the bar. And we'll swing this one around. And then ask yourself in terms of advantages, right? Do I have a clear path? Where's my call out button? And what do you guys think on this one? Do I have a clear path? Is it a term? Is it a 50-50? Is it a clear path? This one's a 50-50, right? The smalls are above, the large are not. So 50% of my triggers have broken. Perfect. 50% have not. So then I'm coming to my entry chart, right? And my rules for a 50-50 based on the KISS plan say, if no divergence, strong triggers, small window, enter at the area. Divergence kills the trade. So I'm writing out what it takes to get me in, right? Yeah, cool. So John, what you did is you typed odds favorable momentum and it kept the box highlighted. So when you copied it and put it over, it only did the box. It didn't do the whole setup. So guys, based on the KISS plan, if I were to take this trade, my entry was right there. Which means that my first trouble spot is here at 73.75, which is only a point away. But what you can do is you can take this picture and you can click copy and drop it in the room, and then we'll have a conversation about everything that you've just told me. Hey, Mark, this is the trade that I took. I had a 50-50 with strong triggers, and I entered at the area inside of favorable large triggers, and by the time it went up to my trouble spot, I had virtually no risk. And look what happens, 50-50, whoops. And now divergence prints, and sure enough, that area didn't break. The lack of divergence gave you a shot at at least making something, but because it wasn't a high probability trend trade, you sat on your hands. And when divergence prints, you said, hell no, I don't want this trade. And thank goodness that you followed your rules. Thank goodness that you had that KISS plan. Because what it did is it gave you the perfect entry, which created a manageable trade. And then when divergence printed, it changed the whole scenario. And then that's crude oil, Lyle. So you waited for everything to stop. And then let's see. That's the S&P that we're looking at here. And then crude oil just never gave an entry, did it? Once everything came together, they said, sorry, Lyle, it's not your money, brother. That's it. You did it. So Lyle, do me a favor. Write on your chart too, even though there may not be anything there to write. And then C-dub. This is for you. When price accelerates away from the large triggers and hits an area, fibs, midbands, if these large triggers remain above the reversal bar marker, that's your gap theory. The gap theory says that when price accelerates away from the large triggers, away from those synthetics, and comes in contact with a fib, or it can be a midband, it behaves as a slingshot, right? It behaves as a slingshot. And when it behaves as a slingshot, price is likely to close the gap back to those synthetic triggers. So this is what we use to identify a midband that's acting as a termination condition. When the triggers are up here, it's likely to close the gap. And then John Tripp, hello, I figured it out. Rockstar, brother, good job. Telling you, nothing we do is difficult. So C-Dub, you said that you took the gap theory. You took the idea that price is likely to close that gap, and you used it to take a trade to get back to. See, and again, there's not a gap theory here, and this is what, no, that's not the gap theory. The gap theory doesn't pull you back to the midband. And there's the misunderstanding, and that's okay. The gap theory says that when you reach the midband, pull up here picture, if the large triggers are a full bar away, it's likely to close the gap back to the large triggers. It doesn't push you to the midband from the large triggers. Does that make sense? Cool. Or if you hit fibs and the large triggers are full bar away, it's likely to pull back. It's not what pushes you away. And what you end up seeing very often is it comes down and then it closes that gap. And guys, this is just a pattern that repeats itself every day. It really is. Lyle, awesome. You almost wrote on it. You got the arrows, but I figure if you can do the arrows, you can do the rest of it. Nice job, Lyle. Now you're in trouble because now I'm going to expect you to post in this room and get all the feedback you can handle. Nicely done. And then what's cool is on this gap theory, guys, I want you to see how amazing it can be. Price reached the midband. Large triggers were a full bar away. It closed the gap. So there it is right there live in the NASDAQ. No shorts even with odds favorable on a 50-50 because the gap theory said it's likely to close the gap. But you'll get to this point where you can take a chart and you can take everything but trigger lines off of it. And I want you to see the gap theory. It accelerates away and pulls back. Dollars to donuts. There was a midband here, right? There was a midband here, and it pulled back. So all we're doing is we're trading patterns. There it is again. Pow, pow. So what you do is you start recognizing these patterns. And what it does is the gap theory isn't designed to keep you going one way or the other. It's designed to keep you from fighting that vacuum. All right, John. At that point in time, so, all right, John, respectfully, I can't tell you what chart this is. Well, I can. It's a 13-2. There's nothing I can do with this picture, unfortunately. If you do me a favor, when you want to talk about 1015 and crude, and this is just part of the learning process. Let me go back to 1015. Let me go back to 1015 on this one as well. And go ahead and snap that picture. Show me the large chart. Show me the small chart. And what you're asking is, were the rules met somewhere in there for the long, right? Here's one of the keys. 72, 52, 52. So in this stretch between here and there, there's not one pullback. There's not even a reversal bar. Do you see that? Which means that if you're a high probability trend trader, if you're brand new and all you're looking for is that high probability trend trade, there wasn't an opportunity for you there. There wasn't a rules-based entry. Cool. When you're at the area, it's that 50-50, right? Small's above, large or not. Let's say that you were going to take this trade, John. From the highest point of support, whoops, wrong one. From the highest point of support to the lowest point of support is right there, from the mid band up to support. The reality is you're already at support before that reversal bar even prints, and that pretty much takes it out of the equation. Which means that if you were going to take that long trade, you would have activated your limit order just above that mid band, right inside of favorable large triggers. But that divergence may have kept you out of it. Does that make sense? So just because there was a lot of movement up, and just because there was odds favorable momentum, and just because there was a clear path, it doesn't mean that there was a trade. It doesn't mean that there was an entry. And unfortunately, this happens sometimes. Sometimes the market gets so much steam behind it that the small crowd can't do anything, right? The small people that give us that push, that was the best they could do, was those three tiny little fluctuations. If they had been reversal bars, I would have looked for an entry right here. I would have also been looking for an entry somewhere right there. It just never kind of panned out, which means that the money made in that particular move simply wasn't mine. And then as you grow with the software, you might say that when the back of the bar clears the area and I have this much momentum, maybe I'll just take a chunk out on the way. And that's how Ron C trades. And it's a different approach and it's not high probability, but when you get really good at recognizing odds favorable and a clear path, there becomes opportunities to make even more. All right, so Lyle, got to write some rules, right, brother? Let's do it together. And guys, I'm going to tell you right now, and Cindy will verify this. I will be a colossal pain in your ass as long as you keep posting pictures without rules on them. I'm going to post this stupid picture and I'm going to say, guys, give me the chance to give you the best feedback. Tell me why you did, right? Tell me why you did. So you're just trying to try it just to get in and out? Okay. You get a pass on this one, Lyle. But let's do it anyway, right? Because, hell, it's a learning class. Did we have odds favorable momentum? And I know that this wasn't a real trade, Lyle, but I want to pretend like it was just for the sake of annotation. Was it odds favorable momentum? What do you think, guys? Anybody can answer. We're just having fun here. We're chart reading. The answer is no, right? And then even more so, and guys, I like this picture because what this is, was it a clear path? It was not. You know what one of my favorite charts are? And it's funny that Gary, that you just popped your head in here. One of the best pictures that I get in this class isn't the trade that you took into problems. It's the one where you post it in the room and you say, hey, my rules weren't met. This isn't my trade. Gary was a rock star at that. When Gary was learning termination conditions and trigger strength, he did such an outstanding job of saying, my checklist isn't met, therefore this isn't my trade. But rather than just skipping it, he would turn it into a visual lesson. And Lyle, I know that you weren't looking for a trade there. You were just practicing with the chart. And do that. Practice entering, practice exiting, practice moving your stops and targets. Get really good at it when there's nothing on the line so that when you do trade, it's pretty easy. But do you see how, and I think that the example or the reason that I wanted to do this, But it really can be that easy when it's time to look for a trade. If you speak to yourself in terms of advantages every time you look at your chart, what it does is it creates this awareness for why you're looking for a trade, for what it's going to take. Anything can happen triggers. Man, I'm excited about it too. Anything can happen triggers, right? No areas inside of favorable large triggers. Guys, this isn't your long, is it? You're giving away two advantages. But as you learn to read charts, anything can happen triggers in a clear path, couple it with an area inside of favorable large triggers, you might be able to take this one and capitalize in a medium probability scenario where you know that you're going to manage it aggressively. Does that make sense? See how here only one advantage is gone and there was still an opportunity to get paid. Once two of them left the building, that market's pushing down lower. So when you speak to yourself in terms of advantages, this is what I have, this is what I see, right? This is the NASDAQ and it has odds favorable momentum. Does everybody see that? Even without areas, odds favorable momentum. Let's load a template on it. Let's see if we're at an area or if it's an opportunity to refine the entry, to look for that area inside of favorable large triggers. It's going to calculate real quick. Ah, and it's a 50-50 trade. And it has four divergences against it. Son of a gun, that's a lot of divergences, isn't it? On an area that isn't broken. That hardly feels like the right thing to trade into. And this is what we do. John, this is what we do, man, every day. We talk about rules. You guys have the opportunity to ask for feedback. And how much feedback you get is 100% dependent on how willing you are to post in the room. The more charts you post, the more questions you ask, the quicker you're going to get to where you want to be. And there's some pretty harsh truths in trading for you guys that have never done it. And I think that the biggest one is that you probably won't win every trade. You probably will not be victorious on every trade. And what I have found in my own personal trading and my own personal history is that when I win $300, it feels amazing. But when I lose 600 taking the wrong trades, I'm still down $300, right? So if I learn to eliminate the trades where I don't have a statistical advantage, what happens is the trades that I take with the statistical advantage have the opportunity to produce more, to give more. Um, and this is one of those things where if you focus on, ooh, that's not big enough. This is from Mark Douglas. If you guys ever want to learn anything about the psychology of trading, Google him. But for me, this is the most important phrase for any trader, especially a new trader, is when you stop expecting to win every trade, you're going to start winning most of your trades because you're not going to care about the result. The results have nothing to do with your desires. Care about your execution of the method. Why? Because when I have these three advantages, this is a trade that typically wins 70 to 80% of the time. And in one of his videos, Mark Douglas talks about this. Think about a coin flip. If you flip a coin, the result is potentially random all the time, right? It could be heads or tails. It's weighted the same both directions. If you weigh one side of it, if you weigh the head side of a coin, it's more likely to land on heads. And chances are in 100 coin flips, 70 to 80 times it's going to land on heads, which means that you bet on heads every time, understanding that you will lose some of them, but your statistical advantage lies in heads. Your statistical advantage as a trader lies in momentum, a clear path, and an entry area. So if you're focused on the execution, if you focus on the process, the results tend to follow. And we're in that last 30 minutes and nobody's posting pictures. So this is where I flap my gums a lot, guys. And I talk about just some of the wisdom that I've been given over the years, some of the wisdom that I took Great question. John Tripp, congratulations. You have learned how to shut me up on day one. Not many people do that. So the one-to-ones, it is a 100% Fibonacci alternate. And if you go to the glossary of common terms, actually, you know what? I'm going to do two things for you. The first thing is I want to talk about how fibs come to be because there's a distinct difference between the two. When you open your software measures every swing, every up, every down, every pivot, and it creates Fibonacci retracements, alternates, projections, and it does literally thousands of calculations. Um, and this is what it looks like. These are all the lines from the calculations before the algorithm runs. Once the algorithm runs, you start getting which lines are most important. Guys, did everybody lose me? Can you hear me? Give me a Y if you can hear me, please. All right, cool. So Joel will know that it's him. If you ever can't hear me, let me know. And then if you see a flood of Ys come after, then you know it's you. And Joel's been with me long enough to know that. So, guys, this is how your fibs come to be. And all of these projections through the algorithm ultimately end up with these lines. These lines are reflections of the psychology in the market. Well, these yellow one-to-ones are based on, we go to the glossary of common terms. These yellow one-to-ones are one mathematical equation. These are what we call 100% alternates, and they come from large swings in the market. So the recipe is from A to B, right? The big swing, and there's conditions that are met to make sure that it doesn't go to this one. And then it creates this low C pivot. So A to B, and then it creates this C pivot. What your software does in the moment is it starts printing these yellow one-to-ones live in the market. And this is a 100% Fibonacci alternate. And what you'll find is that the people that don't have the magic of next-gen software use these 100% alternates. It's a very common projection. So your software will literally print them. And you can see how it started printing at about 10:03, and there it is. And your 100% alternates will be different on your large chart and your small chart because they come from different swings. But what you'll see is these one-to-one alternates, well, in a big run, sometimes they're effective, right? Sometimes they stop the market cold. Sometimes these one-to-ones will catch overrun. But we use the lines just as a spot where we can know where decisions may be made. Does that make sense, John? It gives us the opportunity to see it. It's like fibs that print real time. So these are exact numbers, right? Divergence highs and lows are exact numbers. So we really want to see price reach it in order to go through that little scenario. Price reaches where are my triggers. But what you'll find on support and resistance is it may go a tick or two above. It may go 4 or 5 ticks above because these are areas, right? So if the market is screaming up and it's 1 tick below a fib, well, that might be good enough. But if it's 3 or 4 ticks below, you still have that path. That's I like to share that. I like to share that and let you guys know kind of the difference between the two. And then there's that gap theory again. Price accelerates away from the large triggers. They remain a full bar away. And look at how price closes the gap to the large triggers. Once again, there's that pattern that you guys can recognize. There's that pattern that keeps you from trying the short trade. If you didn't believe the termination conditions, it keeps you from trying that short trade. Good stuff. Great question. And then I want to share this one. I actually put this together one day after somebody sent me a message, and they were a little put out that people in the room weren't taking high probability trend trades. They were a little put out that people were breaking rules, and I was commending them, and I was saying, hey, this is a great trade. And the key to everything that we do, guys, is a foundation. The key is understanding the basics, and then each and every day, each week, you move a little closer to your final goal. So for the new users, I use a blanket theory, guys. I blanket with very conservative rules. I try to optimize your chances of success. We talk very much about the recognition of advantages and a solid plan that optimizes those chances as you learn to read your indicator. Because really, what I am is I'm a crossing guard. Until you learn to look both ways, I need to hold your hand a little bit and make sure that you don't get in trouble. And that's okay. So for new users, terminations are bad. No momentum is bad. Areas outside of the window is bad. And Dwight, yours was a great example of that. There's a point where it's not bad, right? When you can incorporate chart reading. And once you do that, once you're capable, then your plan changes. But as a brand new user, I give you as much safety. I'm like that mama hen, and I've got you nestled in my bosom, and I don't want you running amok. And just like anything, the more time you spend at it, you'll spend with it, the more you'll see, and this opens doors. But one of the biggest challenges is when my new guys, you see older, more experienced users taking trades that don't fit the rules. And for some people, they were the hall monitors in middle school. It pisses them off and it creates confusion, right? And why did they trade in determinations? Or they didn't have the best momentum. How come they went short? And they're breaking the rules. Why can't I break the rules? And the short answer is you don't have the reps to know when it's appropriate. You don't have the experience yet, but you will. And then you grow. And now because you've had some time watching the patterns, you start trading into fibs with overwhelming momentum from a good bottom, and you're capitalizing on these little patterns within patterns that come from your time reading the indicators. So it's a process, guys. Learn the process first. The process yields results. The process teaches you to become a chart reader, and then that opens doors for you to do more things and better things. And I think that the biggest thing is if you try to not keep up with the Joneses, right? John, you're on day one. Don't try to trade like Ron yet. Don't try to trade like me yet. Don't try to trade like Gary yet. Go ahead and be John Tripp for a little bit and give yourself a little bit of grace. It's okay to be new. Learn to read your indicators, and then you'll be amazed at what stems from it. And keep questioning everything. And guys, this is the one thing is sometimes people are afraid to ask questions because they don't want to monopolize time. They think the question may be silly. They don't maybe it got covered. Guys, ask everything. If you're not clear on something, I want you to ask questions. I want you to tell me why. Lyle, I want you to annotate that chart and tell me why you went short at 72.24. What made you feel like it was a good idea? That's all. I'm not even worried about rules while you're learning. So I wanted to share that, guys. Be cool with where you're at in life because it's going to change. So, Lyle, you hit a termination condition and it created an untradeable bounce. And you went short without the advantage of momentum, right? You too, Joel. You went short without an area inside of favorable large triggers, and they took your money, right? Large triggers were up. No reason to go short yet. This is just a holy smokes, I hope it goes down. And then it comes back and it retests the area, and it retests the divergence high, and it retests resistance and resistance, and now your small triggers are below, right? And now all your triggers are below the area, and you've had a couple divergences, and the trend has changed, and you decide to go short saying, these are some weak triggers right at Fibonacci resistance. Let me take a very low risk entry right here, and I'll take it off at that last place that created a bounce. It's still a little premature, but what you've done is you've identified, absolutely, John. You've identified the termination, you've let it slow down and change trend, and then you look to trade off that termination. Joel or Lyle, it's a little advanced, it's a little aggressive, but your entry is right at fibs. You're utilizing Fibonacci to take it. So when we're reading the 5-1, John. So Lyle, not a high probability trend trade. Nice execution, man. When we're reading the 5-1, and I'm going to go through the sequence here as well. We're going to do this again just for clarity. We don't turn our attention to it until the large chart says. And I think that's the biggest thing. Um, so when your large chart says that it's time to go, this is typically the look over here. Everything says up, and you're just looking for areas and triggers. That's the beginning of it. And then once you've decided that it's time to take a trade, you still have to wait for some things to happen. And on the small chart, right on. So Lyle, go through and annotate your chart, right? If you write all the reasons you got into that, what you may have done is created the perfect plan. But if you forgot why you did it yesterday when you look at the picture, how are you going to repeat it? I know it feels like work. Annotate your charts, guys. Um, so, John, when everything says up and you make the decision, everything's up on the small chart, but you have to let that reversal because the rules say we're going to buy or sell a pullback. So in this case, we're going to buy a pullback. The reversal bar starts it. You will, Lyle. I got nothing but faith in you, man. I'm gonna pick on you every now and then, just so you know. When you guys post unannotated charts, I'm gonna let you know that you posted unannotated charts. And I'm gonna have to go through the whole thing for class again and why it's so important. And eventually you'll just get sick of me nagging and you'll start annotating charts. And then once we get the reversal bar, John, that's where we really start that refinement process. That's where we really start pinpointing things. High probability trend trades come from areas. Areas are fibs, midbands, yellow one-to-ones, but the key is they have to be inside of those triggers. They have to be inside of the trigger lines. So if the trigger lines are spread super wide, your window of opportunity might be huge. The tighter they are, the less room there is for for the areas to be in there. And because you have these bounce points inside of triggers, that's where you're going to refine the process, and that's where you're going to try to get in right at the top of the window. And it comes from, and I'm going to tell you right now, in the beginning, you are going to miss them. You're going to overthink it and question things and try and figure it out. And then it's going to start becoming a little more clear. And I want you to see this one. Everything's up, right? Do you see the split on the triggers? Actually, there's not. They're overlapping. The midband's in there, but it goes to the bottom. So if there's a huge gap on the triggers, if they're not just right on top of each other, it becomes a little less clear. There's that 50-50 trade with no divergence, and see how it pulls right back to support right inside, and sure enough it goes. So the more you go through and you annotate these charts and you look at these charts, the slower they start to move. And the more pictures of great entries you look at, the easier it becomes. And that's where I think this is a huge advantage on the spreadsheet is you have an entire page of pictures that are not moving, right? That don't have everything going crazy, but you can see how the rules are met. So you start burning this image into your brain, and what happens is when the market's moving, it becomes easier to anticipate. It becomes easier. And what's kind of cool is you'll start watching the market in a situation like this, and you're going to be like, give me a pullback, give me a pullback, give me a pullback, give me a pullback. I just want a pullback. Won't you give me a pullback? All I need is a pullback. Where the hell is my pullback? And then it happens, and you're like, psh, try to keep me out of this trade. I've been waiting for this damn thing for 15 minutes. And it goes right to the fib with all that momentum, and you feel great, and children sing songs about you, and life is good. But as a brand new user, it's more like this. I think everything's up. It might be a clear bat. Ah, son of a bitch, I missed my pullback, right? Because you haven't really ingrained it. You haven't been able to think of everything just kind of secondhand. And it gets easier and faster every day, and clarity improves every day. And that's okay. It's round, dude, John, you are day one. Let me show you how common this phenomenon is. Are you ready? Let me pull up my internet real quick. If I start typing drink, drinking from a fire hose is the most common search. Why? because I say this to everybody. On day one, that's us, man. There's a lot coming at you. And there really is. And it's like a totally different language because this isn't what you're used to. And that's where I go back to be great with direction first. And John, you're already there. Be good with momentum. You showed me the annotated charts. You understand anything can happen and you understand odds favorable. And then really work those terminations. We had a little conversation about it, but you're going to have to practice that a little bit. Because what happens is if you have a clear path, things are pretty easy. And if you don't have a clear path, well, then you've got to be even more of a chart reader. And your entry rules are different for both scenarios, right? So it's okay to let it be sequential, one after the other. Learn to crawl, learn to walk, learn to run, and then you're going to fly. And be okay with the process. Be okay with the idea that it's okay to not be great at this on day one. And the fact that you're talking is amazing. The fact that you are posting, that you're asking, I'm going to tell you right now, the only thing that could possibly keep you from success is you at this point because you're doing everything right. And we're just going to keep working together every day. Look at that 50-50, guys. It never broke, right? It still hasn't gotten through those key areas. Boom, bang, boom, bing, bang, bing, pow. Those are the sounds that happens from it. And I had an analogy. So, admission of guilt. Novak men stink at analogies. We're horrible at analogies, and we come up with the worst analogies ever. But I came up with one, and I want to see if it makes sense. So, when I have every advantage, when I have every advantage in a trade, when I have a clear path and I have odds favorable momentum and everything says up, go, good, here we go. Guys, this is when the captain on your flight turns off the seatbelt sign. It's a no worries situation. If you got to go to the bathroom, go to the bathroom, right? If you got to stand up and stretch your legs, stand up and stretch your legs. It couldn't get any smoother or clearer than it is. The second you lose a clear path, right? The second you lose momentum, there's turbulence. You have to be prepared. That's where your seatbelt light comes on. That's where you still might make it back from the bathroom, but keep your hand on a seat, right? Don't fall into the old lady across the aisle. And trading is kind of the same way. When everything is perfect, guys, it gives you a lot of freedom to take advantage of things. But when challenges are present, challenges that you recognize through your chart reading, all it does is it prepares you to manage. It prepares you to not hope for the whole home run. It prepares you to look for those divergences, to identify trouble spots. And guys, 50-50 with divergence, it still hasn't gone up. The KISS plan said that that was probably what was going to happen because this optimizes your chances for success. So don't try to be great. Just try to be good at one thing and then build off that foundation. Any questions before we call it? That was an awesome class. And John, you're not going to see it today. I just want you to be cool with that. I want you to go talk to somebody later and go, man, I am freaking confused, but they assure me it's going to get better. What is today? Wednesday? By Friday, John, you're going to be showing me pictures of entries. There's no doubt in my mind. Lyle, you're going to be annotating charts. Haji, you're going to remain focused on the KISS plan, and you're going to be like, holy smokes, I didn't realize there was this much opportunity in the market. And Tony the Tiger is going to say, you know what, guys? When everything's going up and I clear trouble, let me show you how easy it is to capture some cash. And since I knew where the fib was, I exited. That's not a bad day. 28.95, Tony? Getting more and more comfortable with everything you're doing, right? NASDAQ, fighting the small triggers. Ugh. Fighting those small triggers can create a challenge. Wasn't it so much easier once you got to the right side? And I think and you know what? And we forget that sometimes in the heat of the moment. Tony, let me show you a trade that I took this morning. Um, and I had to manage out of it. I took a market flow signal and I entered the market long right here and everything said go. I had a beautiful trade, right? And I waited for the market flow signal and there's my stupid entry right into the small triggers coming down against me. And I had to sit there and suffer, 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 suffer. Well, once I get a close on the correct side, it became a little easier. And it still had to manage out. I gave up. But man, I'm telling you, not fighting those small triggers on the NASDAQ trades, change your world. Let's see if we can find a good example of it. 50-50 with divergence. That's a tough look. Let's see what happens. Smalls below, large above, divergence prints, and price smacks right into the small triggers. Let's see what it does. There you go, Tony. They darn near act like support. And it really creates this patience for you. It creates this opportunity. If you were thinking about getting in at the mid band, those strong triggers said, hey, be patient. Your entry is almost the same. Made it to your trouble spot. Great place to take profits if you got in up here because it's not broken yet and it's not from a good top. So we'll see what happens. But go through, guys. Every time you think there's a trade, take a picture, write your rules on it. Every time you think you missed a trade, circle the tail, see if there was an opportunity, right? You're like, man, did I miss something over here? Let me circle that tail on the 50-50. No, looks like an untradeable bullet that I dodged. But once everything cleared, look how easy it could be. Isn't that awesome? Guys, this creates trust. Going through this method, going back, this creates trust because what you're doing is you're saying it's not perfect and look at the nonsense. And your brain's going to tell you, you're going to open up a chart. And God, I get this all the time. Man, if I just would have went long at 10 a.m., look at all the money I would have made, right? Who sits through this nonsense? My hair's fallen out already. I don't need it to fall out even more. 50-50. There's your second divergence. Crazy. You made the goal before 10:30? Good job, man. Go be a Southern redneck. I like that. Guys, that's it for me today. Thank you for being here. New users, John, dude, thank you so much for posting as much as you did. I want you to do it every day. If you're new in here, I want you to follow John's lead. The more you post, guys, the quicker you'll get to where you want to be. The more questions you ask, the quicker you're going to get to where you want to be. The more annotations you make, the quicker you're going to recognize what it is that you're looking for to get you to where you want to be. So I'm going to be back tomorrow morning at 9 a.m. and we're going to do this again. And we're going to do this every day for the rest of your life until you are so sick of me that you fire me and you go make your millions without me. Just remember me at Christmas card time, guys. I'm going to post the video of today's classroom.